We are seeing some evidence that the economy is indeed slowing.
The Fed needs to be very, very cautious.
It's been impossible to project anything in this weird environment.
I think the Fed put is back. The economy is going to slow, but I think earnings are going to be resilient.
There's still really a good chance that we're going to see a lot of this volatility.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
I might leave this show. I'm getting so much abuse in the commercial breaks. The Christmas tree is going
Quality
up
abuse.
next weekend.
Okay.
Next weekend. So the weekend before Thanksgiving, Bremo.
Okay.
That
Just
works. That's a good thing.
Country living says no, but the family handyman says it's okay to even leave it up all year round.
Country living's the Bible, is it?
Well, I don't know. I mean, it depends on, who you are.
Festive.
Okay.
It's festive. Get into the season. You play a bit of Mariah. It's a good thing. From New York City this morning.
I'm so staying.
Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market's unchanged on the S&P 500. We're looking potentially at an 8th day of gains on the S&P 500. Day 7 yesterday. We've had 8 days on the NASDAQ 100. We've been talking about this rally now all week, Tom. It's a move of more than 8% on the NASDAQ over the last week.
Tangible move for the bulls. It's off the October lows set. What was it, a year ago? We're looking back 13 months now to, the Ralph Ankomper, Ed Yardeni low. Other people were on board there as well. And this is how bull markets extend. And what's fascinating, John, to see is that we've done this without catharsis. We didn't get a VIX out to 30. We didn't get a VIX out to 35 or 40. I got a VIX all the way deep into 22. So it's really interesting to see this lift up, but without that emotion where people climb on board.
We've talked about the pushback in the last 24 hours from Marko Klanovic over at JP Morgan. He's talking about the growth policy mix not looking good into year end. Mike Wilson of Morgan Stanley, I think, might describe this as a bear market rally. Bremo, to hear Ben Laidler of eToro say things like the Fed put is back. I've got no idea if the Fed puts back. I can give you plenty of reasons why it might not be. But ultimately, is that a sign of how quickly sentiment has turned or what? To hear that kind of language on this program.
It's giving some life to this hope, this dream on Wall Street that the Fed is going to come in with significant rate cuts next year. And that will turbocharge a rally without the weakness subsequently in the economy. That, to me, is the takeaway. There is a big divide between those who see the bond rally as a positive for risk assets because it's maybe a right sizing and a devolatilization. I just made up that word. As
nice.
You know.
Nice. It's great.
It's really good.
Keep it up.
CFA level 4 right there.
I'm just wondering at what point people are going to worry about why yields are going down.
What was the word again?
It's really good. Devolatilization.
Love that.
Thanks.
Love that. Coming to a Southside note near you in the next couple of days.
Absolutely not.
Here's your equity market, just slightly negative then on the S&P 500, pulling back a touch. Yields a little bit higher by a single basis point on a 10-year, 457.91. Lisa's going to run through all the Fed speak we get today and through this week. And Lisa, also, all the debt issuance that we get through the next 24 hours.
Yeah, we're going to be getting, I believe, $64 billion over the next 24 hours in terms of 10 and 30-year notes. Today, the Fed speak does include Chair Powell, although don't expect him to actually say anything because it's only preparatory remarks. New York Fed President John Williams, Vice Chair for Supervision Michael Barr, Fed Vice Chair Philip Jefferson, and Philadelphia Fed President Patrick Harker, just a few to come out and try to push back on this recent rally and be ignored by markets like
No, I don't agree. Michael Barr is different. He's separate and different. As vice chairman, Michael Barr is really, John, going to be important on the regional banks. This is in the zeitgeist right now.
Yeah.
Are they going to change the rules? I don't even understand what they're going to change. But this is everybody in banking, commercial banking, is going to listen to the Barr speech.
We embrace division of labor and Ricardo's comparative advantage on this program, don't we? Because you just don't read the Fed speak at all.
I couldn't believe what Ricardo did. I mean, look, in Brazil, when Ricardo went into the pit, that was just not the time to do it.
Okay, we'll leave that there. CK, get to the supply, Bramo.
Let's get to supply, and I'm sure that Tom will find something to disagree with me on this one, too. U.S. Treasury is planning to auction $40 billion of 10-year notes today, coming after yesterday's 3-year auction, which came out pretty solidly. Tomorrow, we have, I believe, $24 billion of 30-year notes. This is the key test. Are markets truly sort of benumbed to the idea of supply, or have they been calmed down by the fact that the Treasury Department did not sell debt in greater volumes on the long end? To me, this is going to be really important. Tom, do you agree?
No, but it's great because when Lisa gets going like this, what time of day is this? When is
It's 1 p.m.
1 p.m. I got to get up from the surveillance.
It's this.
You get
It's
this
this.
going.
It's
This is
this.
the
All right,
Bramo
let's
thing.
move on.
I know.
Entertainment earnings we get. Warner Brothers before the bell, any minute now. AMC Entertainment and Disney after the bell. And I'm really just watching. Yes, we want to hear about Taylor Swift and how many costumes she changed in and out of and then won billions of dollars into her paycheck. But there is a question to me. How much are they going to jack up the streaming on Disney, on Warner Brothers, on all of them more than they already have this year?
It's an interesting question, actually. I mean, it's like $5 here, $10 here, and it adds all of a sudden, it's like real money.
Those numbers just crossed on a Bloomberg. We'll bring those numbers to you in just a moment. A bit of feedback. I was cool with Pharaoh putting up the tree before the pilgrims showed up. Continues. But there is no reason, capitalized. Mariah should be played before December 1. I always took you for an intellectual Pharaoh, and then just shame. Shame. You want me to hold back on Mariah?
I'm holding back on this.
Shame.
Yeah.
Shame. With us around the table, Sebastian Page, Head of Global Multi-Asset and CIO at T. Rowe Price. Seb, good morning to you.
Good morning.
Constructive equities, you've been buying stocks. That's a change for you. Why?
Yeah, I've been saying I was reluctantly bearish for parts of the year. October 27th, market was down 10%. Sentiment and positioning, according to our indicators, was down 1 standard deviation. We decided to buy stocks, and we have a lot of portfolios. We closed a 75 basis points underweight position, but that was $3 billion worth of buying, and we were done by Monday. The timing looks great in hindsight. I got to clarify, we're asset allocators. We look out 6 to 18 months.
Right.
But when it comes to execution, we can be pretty dynamic. And Tom, you had asked me before on the show, what would bring you back to neutral between stocks and bonds? And I'd said, I need stocks to come down, and I need the VIX to come up. The VIX actually was only at 21, 22, but overall sentiment and positioning was depressed enough for us to go back to neutral.
This is a really, really important conversation, folks. And what's so important here is Sebastian Page is living in your world. It's about asset allocation. His book is absolutely definitive. This is the adult read on asset allocation beyond diversification. And I'm going right to where Bramo is, which is your chapter, Momentum in the Study of Horoscopes. You're out there saying it's about horoscopes and, you know, whatever that is. Momentum and something about horoscopes. That's the way the Gloom Crew looks at this market right now.
Well, macro momentum has been negative, and momentum traders, momentum investors tend to look short-term. They tend to look at patterns. And you know what? There is academic evidence that if you look 3-4 weeks out, there is something to momentum. But on the other side of that, you have value-based investors that take a longer time horizon. And Tom, that's what makes markets. Now, I'm learning a new term today, devolatilization.
Thank you.
But that is, you know, that is the debate right now. Rates have been so volatile, so incredibly volatile. And if that calms down, I think there's upward pressure on rates, but nonetheless, that's been the risk driver.
I'm begging the next time you have a T. Rowe Price board meeting that you use the word devolatilization and, you know.
Just for the record, a viewer writes in on Twitter, on X, that actually is a word that I didn't make it up, devolatilization. So I'm just throwing that out there. It means something completely different from what I'm actually talking about, but it doesn't matter. I really want to lean into when the moon rises over Saturn, given the horoscopes that we're talking about. When can bonds be the stabilizer again? Dean Kernet was talking about them being the risk asset. You're basically pushing back, saying that isn't going to be the case for much longer. Are we going back to 60-40?
There are two ways to look at bonds and the stock-bond correlation. I've studied this over years, going back to the 70s, and the 70s provide an interesting analogy to right now, in some ways, not in all ways, but in ways where you see stocks and bonds go down together because of a rate shock. It's very ultimately simple. Are we looking at growth volatility, recession risk, in which case bonds, treasuries should be your stabilizer in the portfolio? Or are we looking at inflation volatility and rates uncertainty, in which case, yes, stocks and bonds will be positively correlated. Going back to tactical, we're still short duration in our portfolio under the hood. We're positioned in what I call the magic barbell. We're actually long credit and long cash at the same time. That, to me, speaks to our view that we're not going to devolatilization so quickly, that there is volatility and possibly upward pressure on rates where we sit right now.
So does that mean that stocks are the new stabilizers, that basically, based on what we just heard from Dan Ives, go buy Apple, go buy Microsoft, and then have cash?
I think that narrative is overdone. At some point, you know, post-COVID, people were describing those big large cap tech stocks as bond proxies. That's not the case. Those are stocks. You sit lower in the capital structure, and stocks are volatile, but that's why you get paid for holding stocks over the long run. So I don't necessarily buy into that narrative that stocks are the new, or in particular, the Magnificent Seven are the new safe assets.
Can you take a long-term view on financials when I don't seem to know what drives them right now? It feels like they're stuck between a rock and a hard place. I had this conversation with Laurie Calvasina of RBC yesterday. Yields were up and that hurt them. But then if yields drop because growth is doing poorly, then that should hurt them too. What helps them right now?
Earnings, ultimately, and if we've bought them in earnings. And let's take a step back. Growth keeps surprising on the upside, and that might continue. We started the year, the consensus GDP, John, was basically 0%. We're looking at 2.3% real GDP for the year. Q3, at the beginning of Q3, the consensus forecast was 0.5% of real GDP growth. We just printed 4.9%.
That's amazing.
So growth continues to surprise on the upside. This is more specific to the U.S., and you got to balance this. So you might ask me, why are you not actually overweighting stocks? Why are you just neutral?
Why aren't you overweight stocks? Why aren't you neutral?
Thank you, Jonathan.
No worries.
You have to worry about the long and variable lags. And, you know, I'm a huge fan of the show. You've been talking about narrative roulette.
I'm glad someone is.
Thank you. You've been talking about narrative roulette on the show, right? The narrative changes every single week. And the best example of that is that we had one non-farm payroll at 150K that was slightly below. We had a slight Fed comment.
Goldilocks
and
is
all
back.
of a sudden, we're you know, the narrative is
Goldilocks is back and Sebastian's buying stocks. Just like that. Things have changed.
There you go.
So it's good to see you, as
Thank
always.
you.
Sebastian Page there of T. Rowe Price. Do you want some numbers from Warner Brothers? Revenue, 9.98 billion. The estimate, 9.98 billion. Barbie was the highest grossing film in Warner's history. Do you know what's lost so far this year in the movie business? Everyone knows it's Barbie. Do you know what was number 2?
The Oppenheimer?
Super Mario Brothers. And it was number 1. Super Mario Brothers was number 1 before Barbie came along. Super Mario Brothers generated $1.36 billion in global ticket sales.
It seems like you're the demographic.
I watched that movie.
You did?
I watched that movie.
With who?
At home on my own.
Jesus,
because of nostalgia of the N64. The Nintendo 64 in the 90s.
Yeah.
And a computer game. And that's why I watched it. Yeah, right, see? That's
like
why I
the
watched
mushroom
that.
and it gets all big.
If you watch that movie, you'll feel the same way. And Nintendo, the reason I bring this up overnight is because they're going to do a movie with Legends of Zelda, aren't they?
And they're doing very well because of it.
So there you go.
I see
There
those
you
shares
go. That's
pop.
the movie knowledge, Tom, and the stock story and financial
keep up with
markets. If you're just joining us, stick with us. There's more to come. In your equity market right now, we're negative 0.02%. In the bond market, Tom, yields a little bit higher by a couple of basis points. 58.53. I'm with Lisa. You've got a test on a 10-year today. Bit of supply. I say a bit of supply. A lot of supply coming from the Treasury today and tomorrow. 10-year today, Tom. 30-year tomorrow.
Well, perhaps confidence building. What I would note about the entertainment business in this WBD is they are 61% debt versus an Apple. I mean, you know, how does Dan Ives say they're going to go buy something? Apple's not debt encumbered. They have massive free cash flow, and people like WBD, they're the other side of the story.
I'm just curious about how long nostalgia is going to work. Nostalgia for Barbies, nostalgia for Super Mario Brothers. This is basically what's fueling profits. It's our all desire to go back to our youth.
Nostalgia for who? This is the important point. Nostalgia for millennials.
Yes, correct.
Because that's where the money is right now.
Exactly.
That's the important point here.
So what other nostalgia
Super
items
Mario
can we
Brothers,
bring
Legend of
out?
Zelda. I think Usher's doing a Super Bowl.
I actually asked my kids.
You see?
I said,
no
have
idea.
you ever heard of who this is?
No idea.
Who?
No idea. That's when you know you've got old, Bramo.
I knew I got old
when
a long time ago.
You're the target audience and the kids have got no idea what's going on. Peter
Thanks,
Cheer,
John.
next hour on Bloomberg. I'm putting myself in the same bucket with you, Bramo. Same generation. Equity futures on the S&P 500. Unchanged. Sydney.
In London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything. The top names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose sides.
Bloomberg. Context changes everything.
I think that the House Republicans and the Senate in general are committed to the government not shutting down. For many reasons, I don't think it will. Or if it does, it'll, shut down for 8 hours or something like that. There is a commitment from both sides, from Speaker Johnson and from the Senate, not to have a government shutdown. How that works out, I can't tell you, but I do think that's a commitment.
It's a commitment. The words of Senator Bill Cassidy of Louisiana speaking with our colleagues on Balance of Power. We'll catch up with Anne-Marie in just a moment. If you are just joining us, here's your equity market picture. The story of the last week, really. Gains, gains, gains. After the last 7 days, 8 days actually, on the NASDAQ, we've had a move of 8.4% on the NASDAQ 100, 8.4% higher. On the S&P 500, 7-day winning streak on the S&P, the longest going back 2 years. So slightly negative today, Tom, on futures, but ultimately over the last week.
Where's the
much,
effervescence?
much higher.
14.8, well, there it is, 14.80 on the VIX. Where's the effervescence? To me, it's just a bid. It's just money coming in. I don't see an enthusiasm. I just see relentless money coming in.
We were spooked by this move in the bond market. Governor Waller of the Federal Reserve calling it kind of
I noticed
earthquake.
that. Yeah.
I think moving down from 5 to the 450s on a 10-year, people taking some comfort from that. Question we've asked, though, Lisa, over the last 24 hours, are we confusing a rally with stability? Is this real stability that we're starting to see in the bond market?
It's a great question.
Or is it just a repeat of what we've seen over the last couple of weeks in the other direction?
I actually think that's the reason why the auctions are so important to watch, and that's why Tom is going to be tracking them, because what I am looking at is the potential for maybe more distaste for how much debt is coming to the market. If you get that today at 1 or tomorrow at 1 with the 10 and 20, 30-year auctions, that could change the picture.
10-year right now about 460, Tom. 30-year, let's call it 473. Okay. Backing away from the highs of the last couple of weeks.
Backing away from the highs. The 30-year bank rate mortgage has gone from an 8.03, 8.05 into 7.83. And that's where the behavior pattern changes. So when yields come in here to your auction, do people say grab it now? I mean, that's the arch decision.
In all seriousness, though, you speak to consumer behavior. Does a move from 8 to 7 make a difference on mortgages?
No, I don't think so.
For me, I don't think that moves.
To me, it's how much buyable house can you buy, and it doesn't change that.
It's a fiction because nobody's actually borrowing it. Did you see the mortgage numbers in the New York Fed survey that came out yesterday, and how much the debt has actually declined because nobody's taking out mortgage debt? Why would they, given that they're paying, 8%?
I'm just reading our emails, some devolatilization.
How's that working?
It's going great. It's kind of
everyone's saying it's a word.
We'll get to that in a moment. Right now, we're going to go down to the volatile nature of Washington. Anne-Marie Horton picks up off election details. Our Bloomberg electoral correspondent. Anne-Marie, open question. Which of these many off-year elections got your attention?
Virginia was definitely the most important one, not just because of how close it is to Washington, D.C. Many felt potentially this could be a referendum on President Joe Biden, and given the fact that we have seen him struggle in the polls, but also for the fact that Glenn Youngkin really was trying so hard, spent a ton of money, spent a ton of personal time and capital to try to flip Virginia so that both the state legislature, both chambers, the House of Delegates and the Senate, were red. Mm-hmm. And actually what he has now is a very divided government with Democrats controlling both of those. And the reason why this was so important is because donors were hoping he'd potentially be a last-minute addition for 2024. Right. I think the fact that Virginia didn't go fully red, you can park that. But also, what does this mean? He's now a lame duck governor. What does this mean for his remaining 2 years? And then is he going to mull a 2028 bid?
Right. What is the question here about anecdote or fact that the Trump people don't show up if Trump isn't part of the election?
Well, I'm not sure if the Trump people didn't show up. You have to look at some of these races in Kentucky, in Ohio as well, that it was very specific for individuals or measures that they were voting for. What was clear last night, whether or not Trump voters showed up or not, what was clear last night is that abortion is still a key issue for voters. And these aren't just Democrat voters, these are independents as well. So for Democrats looking at November of 2024, they are going to spend heavily, they're going to campaign heavily on abortion. You can see some of the change of tone when they talk about abortion. They're now talking about as a freedom, a right. And this is what the president said yesterday when he released a statement that he was so happy to see in these election results that Americans once again came out to protect their freedoms. This is how they're trying to shape the discussion when they talk about abortion.
The confusion that I have right now is that people say that the social issues matter until they don't, then it's all about the economy, and everyone's been saying that. Last night, social issues arguably won Democrats the election in a number of different places. Heading into next year, is it going to be the economy, or is it going to be some of these issues? I mentioned abortion. I also mentioned the Hamas-Israel war.
I think first we still have to remember we are a year's way out. This was a great election for the Democrats. It follows on, President Biden once again bucking historical trends when it came to the midterm election, when everyone thought we would see a red wave. But the fact of the matter is you can have these two truths, which is you can have these off-year elections that did well for the Democrats, but polls again still show that by and large the economy does matter for individuals, and also that they do still think that President Biden is too old. So I still think we are far way off from next year to see what is really going to be a massive driver. A lot can happen in the next year. But to your point, Lisa, about the Israel-Hamas war, most Americans vote on domestic policy. So unless something happens and this conflict spreads throughout the region, has massive impacts, likely this will just be something that happened last year that it potentially is still ongoing, and it's a conflict the administration is dealing with. But Americans are going to vote on things that matter to them in their everyday lives.
Let's talk about the domestic issue that we've been talking about all day, that no one maybe will vote on the interest payments of the United States, even though we're going to talk about it every day. Is that true, Anne-Marie, or do you expect more people to start to say, wait a second, the U.S.'s interest payments may double this year to $1 trillion based on how much borrowing costs have risen?
Well, it's certainly a line that Republicans want you to know because they keep talking about reining in fiscal spending, but they also want to cut taxes. Well, to build a budget, you also need to make sure you're raising taxes. I don't think everyday Americans are going to focus on interest payments. I do think everyday Americans, though, are going to look at their own household budgets. How much more are they spending on groceries? How much more are they spending on gasoline? But at the same time, yesterday, it wasn't economics that pushed people into their votes. When you look at what happened in Ohio, when you look at what happened in Kentucky, when you look at what happened in Virginia, a lot of this had to do with Republicans who made it about abortion. Glenn Youngkin talked about a plan for a 15-week abortion ban. Of course, with exceptions. Virginia is 26 at the moment, and that didn't work. And abortion and reproductive rights still matter.
To switch gears, Anne-Marie Horton, what does the Secretary of State do today, given the immediacy of the surrounding of select parts of Gaza City?
Well, he's in the Asia Pacific today. He's going to be talking to a number of allies. Of course, this is right ahead of Biden sitting down most likely next week with Xi Jinping in San Francisco. He went on this frenetic tour yet again to the region. What he is likely doing, and what you see the U.S. administration try to do, is talk about these tactical pauses. They want to be able to make sure they can get humanitarian aid into Gaza, because the humanitarian situation is dire at this moment. We spoke to Cindy McCain today, the head of the World Food Program this week, and she was talking about how food needs to be able to get through, and they'll take anything they can to be able to deliver that aid.
MH, thank you. Anne-Marie, on the latest down in Washington, D.C. The latest in this market at the moment on the S&P 500, just about unchanged. No big moves this morning whatsoever. When you hear Bramo talk really gloomy about markets, Tom, she's trying to cheer herself up. She's got puppy videos.
Hold on a second.
Up on her Bloomberg, just watching dog videos. So I've just watched you do that for the last 30 seconds.
I just watched the
Literally,
dog video,
just watching
please. Okay, hold
dog
up.
videos.
Okay, full
and
stop.
Forwarding
Pause.
me hate mail from Bloomberg users that readers follows. Putting up the Christmas tree early and watching Super Mario by himself. How many cats does he have? If he has more than 2 cats, he might need a welfare check. 2 things. The wife fell asleep, so technically I wasn't on my own. And the second one, I am not a cat guy. Everyone who knows me knows I'm not a cat guy.
Can I please set the record straight?
Do I look like a cat guy?
No, I know you, though, too well. So I think that this is like, but what I'm looking at right now, the videos just pop up. I don't even follow these
you want to
accounts.
excuse yourself from this?
No, hold on a second.
Well, no, you have some. The floor's yours. You got.
But I will just say this:
20 seconds.
A lot of pet videos in my X feed recently. A lot of them, and I have to say, it's kind of comforting.
I've got Elon's bots popping up in my X feed, and people are going, "Oh, really?"
You're getting comfort from dog videos.
I like them.
Nice.
Yes.
Same.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Next week on AI IRL.
It's talent that drives, this innovation, and talent still concentrates around a small number of physical places. I do think China is going to catch up. I think they're going to develop their own AI chips, their own fabrication facilities, but that is going to take 5 years or so. The export controls that the US has implemented, are real.
Equities just about unchanged on the S&P 500. Quite a run over the last week. You know the stats by now. 7 days on the S&P. 8 days on the Nasdaq 100. Futures going nowhere on the S&P. Currently on the Nasdaq, we're negative by 0.03%. Small caps really volatile. The Russell this morning down about 1/10%. The rally inspired by the move in the bond market. 2-year, 10-year, 30-year shaping up as follows. Lots of issuance through today, tomorrow. 10-year maturity, 30-year maturity. The 30-year at the moment, Lisa, 471.69. 10-year yield higher by a single basis point, 458.11.
One of the big questions to me is just how many of the institutional buyers that have been sitting on the sidelines waiting for the volatility to die down will come back. And to me, this has been one of the big questions because we haven't understood the move, because we didn't understand how much leverage or hedge funds or just fast traders are behind it. A lot of people were waiting. If they come back today, will that fortify the rally we've seen in the bond market?
$40 billion of 10-year notes a little bit later on this afternoon. On to tomorrow afternoon. $24 billion of 30-year bonds coming to market. So that's stocks and bonds, the relationship between the two. I think it's always really, really hard to make a call on the future and then make another call after that. So let's say you can predict the future perfectly and you can say things are going to happen in the Middle East. Tension's going to boil over. Israel's going to go to war with Hamas. Let's say you saw all those things the week before it happened. Then you made a call in the crude market. Look at crude right now. We've had a big move lower through the month of October.
Wow, down a stick.
We add to it, we're down another $1 on crude this morning, Tom. We're down 1.3%. 76. We're talking about lows we haven't seen since July on WTI.
You know, never pick crude. It's the toughest thing to call. I'm going to go to Javier Blas on that, but to me, it's all about global demand. And I'm going to go back to Nick Benenbrook of Wells Fargo with a stunning 2.4% global GDP. And he rationalizes out and says it's going to get better. That's the here and now. And the here and now is a global recession if you use what I'm going to call the traditional benchmark 3%.
Start of October, we're focused on supply. Yeah. Here we are in the middle of November. Lisa, I think we're talking more about demand now, less about supply.
Especially as the U.S. government put out a report yesterday saying that American gasoline demand would actually decline quite considerably into next year. So at what point is this a slowdown? At what point is this a switching to other types of fuels? I don't know. It's that dark matter that Neil Kashkari was talking about, but he was talking about it with respect to bond markets.
Confusing at one point that conversation was, I have to say. Brent crude at 80, WTI at 76, under surveillance this morning. Israel saying its troops have entered the middle of Gaza's main city as Prime Minister Benjamin Netanyahu reiterated there'd be no ceasefire until all hostages are released. G7 foreign ministers, Lisa, releasing a joint statement calling for humanitarian pauses in the conflict. Biden urging Netanyahu to agree to a 3-day pause, according to Axios.
It's a horrific conflict, and there's so many civilians caught up in this, and all of us who've been watching the imagery, I'm sure, have this real desire to see it stop, and for a lot of these, particularly children, to have a better situation. The difficulty that we have right now is this question of how to do that, right? Because if Israel says a humanitarian pause will re-embolden Hamas, let them sort of rebuild, the war continues, it could prolong things. This is sort of the question underpinning this, and the immediate scream, to Tom's point, we're all seeing these images. Everyone's just saying, please, make it stop.
It's the speed of it. I mean, I'm not even going to quote the details. I think I know from media reports. It's just they're happening within a 1-hour turnaround. I mean, there's no jokes to be made here. This is absolutely revolutionary, the transfer of information.
I think we're all closely watching, monitoring the approach of this president in the United States. The president publicly standing shoulder to shoulder with Israel, privately, based on reports, Lisa, trying to put pressure on them to conduct some kind of humanitarian pause. Whether the pressure builds to such an extent that he has to do that publicly a whole lot more, that's something I think we need to look out for in the weeks to come.
I think that's a very good point. There are two things here, though. Hamas is looking for some of these images to get out. They have said publicly that they want to have martyrs that can show the world what they're looking for. So you have those images, and then you have certain Western leaders and, frankly, Middle Eastern leaders that are grappling with the emotions and the protests of civilians. So at what point do they have to respond to those in a more material way? We'll
monitor the news, the incoming information as it comes through, and share it with you as we get it. Elsewhere, the third GOP presidential debate tonight at 8 p.m. in Miami. 5 candidates are making the cut. Ron DeSantis, Nikki Haley, Vivek Ramaswamy, Tim Scott, and Chris Christie. Trump, of course, once again, sitting out. Tom, holding a competing rally nearby. So we've got 5 candidates on the stage, the president elsewhere.
Yeah, well, is it a Florida dynamic or a national debate? And I really don't know, because Florida is so damn important. I mean, I would defer to Anne Marie Horton, Joe Matthew, and others, our wonderful Greg Gillespie. Greg Giroux, rather. I just, to me, Florida is different. And it's really cool to have any debate there, Republican or Democrat.
So you know where the polls are, Tom, at the moment for the party. Split down the middle, the former president on the one side, and then 5 on the other.
Yeah.
You know who's got momentum right now? Nikki Haley. Bit of support from Governor Kim Reynolds earlier this week from Iowa for Governor Ron DeSantis. Maybe he can pick up some momentum from there. But ultimately, the clock's ticking here, Lisa.
Yeah.
You'd have to imagine that we have to see more Pences stepping out and more people consolidating around one candidate to take on a former president in the primaries.
And so today, do we start to see some consolidation? Is the pushback going to be more directly at the former president? And is it going to penalize the former president in any way, shape, or form that he keeps not participating in these debates?
I want to finish on this story. We're going to be talking about this for years to come, I think decades. The collapse of this company, WeWork, threatening to upend dozens of leases in cities, including New York and San Francisco. The co-working company, once valued at $47 billion, planning to terminate nearly 70 leases. WeWork's landlords facing pressures from a decline in tenant demand. Tom, it's from $47 billion in private markets in 2019 to bankruptcy 4 years later.
And it's, again, overcome by events. It's not only the stories we know and the failure of management and the failure of this and that, but all of a sudden running into the fact of a commercial real estate implosion. That wasn't in the original calculus about the collapse of this company.
Adam Newman, he won ZERP. That was the headline yesterday, without a doubt. How did he walk away from this with hundreds and hundreds of millions of dollars, except didn't just walk? He was almost pushed. He was pushed.
He was pushed at the peak of the market.
Pushed. It's just amazing, Tom. Amazing.
We're going to see right now on the bond market, which itself is amazing and with years of experience. Deborah Cunningham joins us now, Global Liquidity Markets CIO at Federated Hermes. Yield is moving. Will the massive movement into money market funds end, Deborah?
Actually, I think maybe the retail side of it will slow down, Tom, but the institutional side is just getting started. Generally speaking, institutional flows into money market funds stay in the direct market. So in treasuries, in commercial paper, in other types of products that are directly impacted by the Fed's rate changes on an immediate basis. They don't go into money funds, which lag that market, that direct market, until rates peak or plateau, and often start to go down the other side. So I think the institutional trade will that spigot will just turn on.
For simple people like me that want a 10-year yield tip point where short-term paper doesn't become attractive, in your head, where does the 10-year yield need to get to before the facts change for the people loving their 5% accounts?
Well, you've got the 10-year now right around the 460, 458. I think that's very much indicative of what the Fed has been telling us, higher for longer. It's also indicative of the most recent Fed speak from Jefferson, from Powell, about the fact that they're still assessing what rate hikes that were done in the summertime, in the spring and the summertime, are having on the economy today, and what the higher bond yields were having. Now, those higher bond yields actually, kind of left the system after last week's Fed meeting, and certainly the payrolls number on Friday. Yet when you really think about it, are those numbers so bad? They're not bad in the context of a continued, slower growth economy, and they continue to indicate that we won't be going into a recession. So, maybe where we are right now at a 458 in the 10-year is a good place for them to be. It's a good place for them to hang out for a while. It still indicates that interest rates aren't going back to something, levels like 0 or 1 or 2%, but they're going to hold, and there needs to be some premium as you go out the yield curve, plus some built-in expectation from an inflationary perspective, whether it's 2 or 3%. The market thinks 3, the Fed wants 2.
Deborah, can you give us a sense of the tipping points where money comes in or out of money market funds? In other words, when yields reach a certain point, people start to say, wait a second, maybe I should take my cash and put it to work in stocks versus it's actually at work in money market funds.
Lisa, I think Bloomberg did a piece maybe a month ago about 5% yields on cash products, on money market type products. With $5.5 trillion to $6 trillion in the market, 5% yields, it's adding 1% to GDP. I think that 5% number to some degree is a tipping point. We're well above that still at this point. But at some point we'll cross down through it. And I think that's a magic number for people. It's meaningful in the context of the economy, and it's meaningful in the context of people's income. So I think that 5% number becomes something where people start to segregate cash again. So cash, we've learned to put into buckets: operating, what would be strategic, and then core. And everything all of those have been in the money market side for, the better part of a year and a half now. At some point, core will start to peel off, strategic will start to peel off, and operating will remain. And I think, 5% is where that process maybe begins.
So just real quickly here, Deborah, how sticky is the money that has flowed into money markets, arguably away from other asset classes like stocks?
I think you've got a good stickiness of the retail trade. The retail trade was really not coming out of equities or longer-term fixed income. It was coming out of deposit products for the most part. You can see as deposit products have gone down by $1 trillion, money funds have gone up by $1 trillion. So that retail trade is about as sticky as it gets. The institutional trade, like I said, that hasn't really even started in force yet, will be the more transitory trade, and we haven't really started to experience that yet. So I think what's in there at the $5.5 to $6 trillion is fairly sticky money at this point.
Deborah, thanks for the update from you and the team.
Actually say something that's going to be meaningful when he's introducing a conference on data. He's going to say we're data dependent. It's more than ever important for this to be a data focused Fed.
Tell some jokes.
Tell some jokes. Talk about the weather.
What kind of jokes?
Talk about when he's going to set up his tree.
Chairman Palkey,
We're on the x-axis.
550 ways to say proceed carefully. Classic. If you're just tuning in, welcome to the program. Your S&P 500 looks like this. On the S&P, we're positive 0.01%. Yields are up a single basis point, 457.91. I do believe there's a panel tomorrow, right, Bramo?
Yes.
Bit of back and forth, the moderator.
He is going to speak tomorrow, and that people are watching for him possibly saying something. He could say something today. He might surprise us.
The IMF panel, Gita Gopinath, Rogoff, I think, is maybe on board that as well.
What we're looking at right now is the potential for the Fed to try to jawbone the market into less complacency that they're done. However, honestly, Fed Chair Jay Powell had an opportunity to say that there was another hike squarely on the table. He could have leaned into that last week. The fact that he didn't, to me, was arguably one of the biggest generators of some of this rally or stability, as some people would call it, in the bond market.
We got some real movement here right now. I mean, we've got green on the screen. The VIX comes in as well. But, John, to your point on oil, and you nailed this earlier, you were out front of the move that we're seeing now on West Texas Intermediate, decidedly below 78. We're down a solid 1.5%, 76.19. And euro yen just went out to new yen weakness. And that, it's a was it today, Wednesday?
Yeah.
The sabbatical.
It's Wednesday, yeah.
But, on a Wednesday, maybe I'm not worried about euro yen, but going into the weekend with a 161, dare I say 162 euro yen, what will the Japanese institutions do?
I was having one of those weeks where yesterday felt like Wednesday.
Yeah.
The week is long when you're not with me, TK. I miss you.
Oh, please.
It means so much when you're back. It's Friday already. It's a beautiful thing.
It's a beautiful thing. I'm going to tear up. It's emotional. The sabbatical was awesome.
Was it?
It was
Nice.
great. I got below 59th Street.
Oh, what'd you get up to?
Yeah, I got down to like
peeking through the windows at work.
Josh, that's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
So you told your mother you'd like to go to Africa and see the chimpanzees, and what did she say?
Not the chimpanzees, I would have studied anything.
Well, what did your mother say to anything?
If you really want to do this, you're going to have to work really hard, and if you don't give up, hopefully you find a way.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
I think the bigger thing for Apple is I think they're finally going to look at M&A. I believe ESPN is the asset that ultimately they'll buy. It goes back to the MLS deal. That was, I think, where the light bulb went off. In terms of live streaming sports, I think ESPN's a unique asset.
Dan Ives, Senior Equity Research Analyst over at Wedbush, thinks Apple might make a play for ESPN. We'll talk about that in a moment. Welcome to the program. Thanks for being with us. Your equity market right now on the S&P 500, just about unchanged to positive after 7 days of gains. 7-day winning streak on the S&P. Can it become day 8? Already the longest daily winning streak of the year so far for 2023. Yields higher by a single basis point on a 10-year, 4.58, backing away from the multi-year highs we saw a few weeks ago, 3 Mondays ago now, I believe, on a 10-year. That was 5.0187% on a 10-year. We've backed all the way back down. More than 40 basis points that move, Tom, over the last couple of weeks. Your yield this morning, up a single basis point.
You know, the yield movement there is fine, but it's also in credit as well. Lisa, what has spread market shown in this bond rally, price up, yield down? If spreads come in nicely, like,
oh yeah, big time.
All's quiet on the Western Front?
Massive rally in spreads, which is the reason why everyone is selling debt right now to lock in the yields. And this is the question: at what point does supply overcome the events of a rally?
It does take 10 seconds here. Is it almost irresponsible that these mega magnificent 7 don't take on more debt? I mean, they just feel like they're just, everybody else would have a responsible amount of debt. They'd have a bunch of consultants and Wall Street firms say you need 13% debt, 14, whatever.
But if they have all this cash that they can actually earn 5% on, why would anyone say you should issue debt at 7% and pay 7%?
But they're not issuing it at 7%. They're giving it away. I'm looking at a Warner Brothers piece here at 4 3/8 roughly down, but they're not Warner Brothers. I mean, they're issuing debt at what? T-bill rates?
If Apple do come to market, the man himself over at Apple, CFO, very, very good at timing the credit market. So I'd have one eye on that as well.
I would. Okay, well, let's do this right now. In the streaming business, the challenges that we see, Geetha Raghunathan joins us now, U.S. media analyst at Bloomberg Intelligence. Geetha, I looked at the equity space, and with Warner Brothers Discovery, Warner Brothers Digital, whatever it is, they're down. But what I did is I went over, and you can do this on the Bloomberg folks with the DDIS function. I went right over to the bond space, and they're down in the bonds as well. I mean, their short-term paper has gone down 6% in price, given all these challenges. How and when do they recover?
They really shouldn't be down, Tom. I mean, today they posted really good results on a lot of fronts. And so, I mean, the big thing that we're looking for from Warner Brothers Discovery is, good free cash flow. And they kind of stunned there with over $2 billion. We were expecting about 1.7 to 1.8 billion. Adjusted EBITDA, again, came in above estimates. But most importantly, and this is something that we're tracking for all of the media space as they kind of undergo all of these headwinds, we know that their linear TV business is challenged. But what about the streaming business. Is that something that can, generate sustainable earnings? And, Warner Brothers has been one of the first media companies, apart from Netflix, to show that streaming can, in fact, be profitable. So they lost about $2 billion last year, but so far, year to date, they are actually up and they posted a streaming profit. So, they're doing, obviously, revenue trends are a little choppy. There's no doubt about that, but they're doing everything they can to make sure that the model is sustainable, to kind of future-proof the business. And, I kind of give them full marks when it, comes to results and streaming profits and controlling costs.
And yet the stock is basically where it was about 12 months ago, just looking at the chart here, Geetha. Does Barbie not make a difference to stocks like these? Does it make a difference when you basically produce your biggest movie ever?
It is the biggest movie ever. It's been a total home run for Warner. There's no doubt about it. But unfortunately, there are just too many uncertainties right now, John. I mean, you have the Hollywood strikes that have been dragging on. We've seen kind of the whole film slate. There's just this overhang on the film slate. We don't know when that's, TV and film production is going to resume. We don't know when we're going to get new streaming content, new film content. So there's obviously, a lot of uncertainty there. And so then that kind of raises the question, what happens to the advertising business? So if you look at their TV business, it's obviously kind of in the doldrums. Advertising has been down double digits all through this year. Again, ads were down about 12%. Affiliate fees, which is, dependent on the pay TV universe, again, that was weak as well. So if you're kind of looking at the long-term, a model here, there is a lot of uncertainty still with the TV business. And I think that is what is reflected with the stock and the price today.
Geetha, as you know, after the close, we get the numbers from the Walt Disney Company. Let's talk about that a little bit. Consolidating ownership of Hulu. At the same time, we've got people talking up the sale of ESPN, ABC, almost encouraged by Bob Iger earlier this year. Geetha, what's happening on that front? Who's buying what? Who's selling what?
Yeah, there are just so many moving pieces. Bob Iger obviously is juggling so many balls, and it's going to be interesting. So we know that they're looking to sell, their India business. As you mentioned, they're looking to sell ABC. ESPN again is a big question mark, but I think that they actually want to hold on to ESPN. They're looking for a minority stakeholder, probably from one of the leagues. Ultimately, I think their whole idea of consolidating Hulu is to kind of make this streaming bundle, and so to have Disney Plus, to have Hulu, and then to have a really robust ESPN streaming product, I think is the way that they kind of stay on top in the streaming war. So I'm not really sure they want to necessarily get rid of ESPN, but obviously they do want to have a minority partner there.
Dan Ives was saying the price of $40 billion could get it done, and Apple will do it. Do you buy that?
Yeah, it's going to be really hard. I mean, again, it does come down to the price. I mean, we've kind of valued the business. They generate about $3 billion or so in EBITDA. We think, anywhere from about 22 to 25 billion in terms of valuation. But of course, if they can get the $40 billion valuation, I mean, Bob Iger might really consider it.
Geetha, I got to say, I did some research last night looking at the price increases for all of the different streaming networks, and they've all increased over the past month or two for $2 to $3 a month. And that's just for the basic service, much more for some of the ad-free services. When do people say enough is enough? We're paying 3 times as much as what we paid when we just had a cable bundle, and we can't find anything.
Yeah, that is the big question, Lisa. I mean, we're definitely heading towards a shakeout. You're absolutely right. Every service has kind of raised their prices. I mean, there are 2 things that are going to happen here. Obviously, everybody wants to have higher ARPU so that they can kind of get to that streaming profitability metric quicker and quicker. And then the other aim is to kind of push more and more people into the ad-based tier. So they're raising prices on their ad-free tier so that, people at some point kind of say, okay, you know what, I'll bite the bullet, I'll take the ads, and I'll start watching. I don't mind watching a few ads if I can pay less. And that's kind of what Netflix's approach has been. That's been Disney's approach. Discovery also did the same thing. So, ultimately their whole aim is to kind of beef up that digital ad business if they can.
Geetha, does finances matter now? And to go to the weighted average cost of capital screen in the Bloomberg, to go Warner Brothers Discovery with 60% debt, these are rough numbers, folks, to Disney's 22% debt, or even Netflix's 9% of debt. What sway right now, what weight do the financial people have in your world?
debt has been a huge concern, definitely for a lot of these media companies. Of course, for Warner Brothers, the big question, and Paramount is the other name that kind of comes to mind with a huge debt load. The good thing with Warner Brothers is that they're actually using their cash flow to get to that, leverage target. Last year, actually, we had them at over 5 times, I think 5.1 times net debt to EBITDA. They will probably end this year, below 4. They will probably end next year below 3, and that's really what the street is looking at. And I think as long as they're able to keep delivering on that deleveraging tactic, I think they should be in good shape.
Geetha, thanks for the update. We'll touch base again tomorrow when we get the Disney numbers. Geetha Ranganathan there of Bloomberg Intelligence. Disney, that stock this year is down 2.6%. On course, and I wasn't aware of this, a 3rd consecutive year of losses, Tom.
It's like the bond market. It's like the bond market.
It's not been a great comeback for Bob Iger over at Disney.
You bought this for the grandchildren. I mean, you bought shares. You got them printed out with Mickey and Minnie on them and all that. And it's like the bond market. It's an absolute train wreck.
Well, the Mickey and Minnie part was doing fine, and the cruise liner is really doing great. I've heard that they are really good cruises, and you should definitely try them out. But I do think that there is this arguably question around their expansion of streaming, their lack thereof, the investment in content, and a question of what the future is with that particular.
You pushing cruises on us?
I think that it would be really.
It's a trend. No, we're talking about a surveillance
messages
cruise.
I've had about cruises since I was away.
Well, we're talking a surveillance. Look for a surveillance cruise in February. I think
we'll take the cats.
We'll take the cats. And the Christmas. They'll wear their floaties.
They put a tree up on the.
If they can.
I can't imagine anything worse. Can you? A cruise over Christmas? Brutal. Can you imagine? Cruise over Christmas?
Depends on where.
It
could be festive, the whole family.
Stuck on a boat with everyone? Absolutely not. Coming up, Peter Chair of Academy Securities. Equities right now just about positive from New York. Good morning.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his 2 jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will
this be the last of its kind? No, this is the nature of capitalism. Get over it.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
This is Bloomberg.
The Doves can basically say that the labor markets have been rebalanced.
It's clear that there's some softening in the labor market, but there's not a collapse.
There is the high probability of rate cuts next year.
We'd have to see pretty severe deterioration in financial conditions to see rate cuts.
We're going to be discounting the Fed cuts that are coming. That's the bullish case for 2024.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bloomberg Surveillance on radio, on television, green on the screen. Futures up now for the first time in an hour. Jonathan Farrow, oil. Moments ago, American oil falls below $76 a barrel. I did not see that coming.
After a 10% move in October as well, Tom, it makes it so difficult to call this market. Things have changed so quickly in just 2 weeks. Jim Carrey and Morgan Stanley on the program with us yesterday, saying that we've gone from the big bad wolf to Goldilocks in about a week. And the interesting thing about this year, Tom, is that can flip the other way just as quickly. The bulls feel good right now because they believe the doves are in control on the FOMC. Let's see if the data changes that story into year-end.
Lisa knows all the speakers for that, but to me, the basic theme here is follow the data dependency, and the answer is there was a seismic shift. I'll let you decide when. And the thing to me, John, is we're seeing it day after day. I got futures up 3, the VIX 14.74.
To me, I'm just watching to see when this is going to shift, whether we're going to dig in. And I think that the auction that we see at 1 p.m. is going to be really important today to get a sense of that, because a lot of this has hinged on the bond move. The sense that maybe we have stability in a whole number of fronts and we can go back to normal, whatever that means.
But what if we have a normal auction? You clearly believe we're at real risk of something odd. Fine. I'm not a pro on this. If the auction is quote unquote normal, then what?
Then we have a rally. If the auction is normal and you see all of the buyers line up and you see the technicals really show strength in terms of the demand picture, I would guess that this rally has legs, because all of those institutions, like Bob Michael over at JP Morgan Asset Management, who's been saying this is a value buy only when you do see stability and a sign that maybe some of the histrionics of the recent moves have died down.
Peter, share with us in moments here. We're going to really dive into that idea of the 10-year moving lower. John, if you get price up, yield down, I'm sorry, it's just like stocks. They pile on. I don't see the pile on yet.
That move, Tom, over the last couple of months has spooked everybody. On Wall Street, on the FOMC, across the board, and I'd say arguably behind the scenes, maybe even in the White House. It's been a big move higher. Treasury's tried to come out and say it's not about supply. Everyone on this program for the last few months has basically suggested that's an element of the move. The fact that we've come down from 5 to 450 makes people feel a little bit more comfortable. I'd point out this. Still look at the intraday moves. They're still quite large and sometimes on nothing, which is why I do wonder whether we are confusing a rally with stability. It's a rally. Without a doubt, the price speaks for itself. Is it stability? And that's what Bramo's looking for a little bit later on this afternoon. You get that kind of stable auction that we can just walk away from. No news here. The bulls will stand a little taller. We can walk away from this.
Let's do the data, John. The VIX, the regular Standard & Poor's 500 VIX, 14.73 in from 21. And as Dean Kernett said, even more important, I never quoted John, the NASDAQ VIX, 18.45. I guess is a big deal.
Equity's doing better than okay over the last 7 days on the S&P, 8 on the NASDAQ. Futures right now positive by 0.1%. Yields going nowhere. The 10-year 456. One eye on crude all morning. 76 on WTI. The lowest since July on WTI crude. Brent threatening to break 80 this morning. $80 and about 50 cents. Brent crude is negative 1.4%. Lisa mentioned the auctions a few times, Tom. Let's go through the numbers again. $40 billion of 10-year notes this afternoon. Tomorrow afternoon, $24 billion of the 30-year maturity. So look out for that in the next 24 hours.
The 10-year real yield, I haven't quoted it yet today, 2.18%, down from 2.50%. It's easier out there to do business this morning. Our guest of the morning to synthesize all this without question, Peter Shear joins us now, head of macro strategy at Academy Securities. You look for price up, yield down. What will that do to the equity market?
I think for now it's going to be good. I think we see 430 on 10s before we see 475. I think the pain trade is actually to lower yields. A lot of people who were bullish at 5 kind of got short again. I think that works until we get down to about 435. Equities rally on the back of that. Then we realize we're getting there because things like oil, copper are receding because the economy is actually slowing fast. So I think at that point, that's when the recession fears start getting priced back into stocks.
Take an Academy Securities 3-year view. You've got that slowing global demand. Nick Benenbrook on from Wells Fargo, stunning with a 2.4% global GDP call. Can you own equities out with a 3-year vision?
I think you could if you had a 3-year vision. I think right now it's more like a 2 to 3 week vision. Everything's so volatile. We don't know where this economy is turning. We don't know what's going on there. And one thing that's starting to scare me is we're having a lot of discussions about the Middle East. We're starting to hear a little bit more concerns about supply chains. I don't think it's an issue today, but as this drags on, if there's any degree of escalation, supply chains become an issue again. So I think that will be a big drag on the economy.
The Middle East, crude. Last month is just unreal to see a move of almost 11% lower on WTI, even with the heightened tension in the Middle East. A lot of people, Pete, are pointing to maybe demand starting to crack in certain places around the world, Europe, maybe even the United States going into next year. What's your view on that?
Yeah, I think the last time I was here, I said buying oil was not going to be a good hedge for escalation there because oil had been under so much pressure before, and I think that's what we're seeing again. There's just that lack of demand, and the Saudis definitely have the ability to turn on the tap if they want. We're clearly trying to figure out how to work with Venezuela, and so far it looks like Iran's going to continue to pump oil despite the sanctions, despite the heightened tensions there. So there's not much in favor of oil right now, and I think that's a very crowded long position, so I could see that breaking lower.
Going into next year, you mentioned a 2-3 week view. I'm with you. You know what's about to happen, though, in the next 2 to 3 weeks? We're going to get a load of people publishing their outlooks for 2024. Can you help us understand how you get any visibility whatsoever into next year? What's the strategic view going into next year?
I think there's still some big themes. I think AI, how people are using AI, the efficiency that could cause for companies, I think that's going to be a big theme still. So you can look over that. Where are we going to be on the defense spending? Where are we going to be in terms of geopolitical spending? I think the reshoring is still real. I think a reasonably healthy economy with their decent jobs is still the overriding thing. So I think markets are a little bit more volatile right now than the underlying economy is.
So if you put this together to what you said earlier, that you see benchmark 10-year yields getting down to 4.35% before going back up to 4.75%, or just basically they're heading lower. Does that mean that we're going to have slower growth, but still the soft landing, and that it basically people are going to get a little concerned about stocks, but that it sets up a rally? I mean, I'm just trying to understand
I think
a very convoluted range of thoughts.
So I think as we move towards 435, you get this, this is all good for stocks. And then as you start moving below 440, I think people realize, oh man, we're getting there because things are not good in the economy. The job market has changed. White collar workers aren't doing as well as they were. You're seeing, I think, some potential for spending. You're seeing little cracks in the housing prices. So I think all of a sudden by year end, we're going to be back on a hard landing discussion, and it'll be the boy who cried wolf, but we'll all be back talking about no more soft landing. We've overdone it.
So you think that at that point, treasuries will continue to be havens once again, even though arguably one of the biggest drivers of the yield move has been Washington, D.C., and it doesn't look like that's changing.
That's not changing, but again, that's a 3, 5, 10-year sort of pain. It's, we get ahead of ourselves, and I do think the one problem we all have is the bond market's so big. You talk about these numbers, $250 billion, and it's huge, but it's, a fraction of 25 trillion. So I think the ability to digest this, you see corporate bonds come out 22 billion yesterday, I believe it was. There's no problem digesting this. So I think the market's pretty healthy. I think people see yields as attractive. You're going to see people continue to add to that. So I think that's fine. It's going to be the risk side of things that gets people a little bit more spooked.
Tell me about the November real yield shift we've seen. We've seen the 10-year real yield migrate 2.50% to 2.19%. That makes things easier for everybody, right?
It does, but I think the nominal yields still play a big role. They're still relatively high, and we had that move from 375 to 5, so we haven't clawed a lot of that back. I think there's this long, and variable lag time is really long this time. People did such a good job locking in yields. It's only now that you're hearing more and more people have to roll over their debt, right? If you issued 2-year debt back in the heyday, now it's rolling over. 3-year debt's not quite rolling over. So I think we're just starting to see that slowdown impact. And I think one point John brings up, we've got what we've been calling this faux liquidity, this fake liquidity. It feels like the markets are super liquid at any given price point, but the ability to gap high or low is there. So I think we got pushed to 5% by people getting stopped out, pushing on yields. We're now got back to 450 in a heartbeat because people are getting stopped out the other way. So that's what we're trying to, I think, manage is like, what's the real noise versus the signal?
You mentioned the great financing of the pandemic, the huge wealth transfer we had from Treasury to the consumer. Consumer balance sheets were stronger. Everyone under the sun who owned a house, remortgaged, termed out that debt, low rates. Corporate America did the same thing. One place didn't, Treasury. Stan Druckenmiller has been very critical of leadership at Treasury over the last, 5 years through that low interest rate period, not terming out the debt. What are your thoughts on that? What do you think about that conversation?
Yeah, I think they should have done what corporations did. I'm always a big believer, right? Borrow long, it locks in, you reduce volatility. And we're having a lot of conversations with clients, probably a little bit hypothetical at this point, but maybe people are supposed to be underweight treasuries and T-bills and way overweight, whether it's commercial paper or corporations, that, right, if you take a step back and talk about this as being governance, right? The U.S. governance is awful right now in terms of our spending, in terms of we talk about not paying our bills, right? You look at the large corporations of the world, they have good corporate governance, they have global plans. They never once would ever even think about saying, oh, we're not going to pay our debt on time because we don't feel like it. So I think you're supposed to be starting to push really heavily to overweight high-quality corporates, maybe in commercial paper, maybe some ABS, and move really underweight T-bills.
So do you foresee a time when Apple can borrow at a lower rate than the U.S. government?
That ability to break the sovereign ceiling rarely happens even in emerging markets. I don't think it happens here, but I do think you can see really tight spread compression, especially at the front end of the corporate bond curve. So I like that as a trade.
You think we get convergence, spread compression on governance issues alone?
I think that will play a part of it. Yeah, I think the top quality companies have a ton of cash. The liquidity in the bond market's not what it once was. So whatever you have to pay up to own T-bills, maybe you don't. And I think this government issue is going to become a real thought. Again, if you think about it, why would you lend to someone who talks about not paying your debt?
Because for a long time, they've had the privilege of acting recklessly.
Correct.
We've talked about this so many times. There's been no consequence for it. Why is this time different?
I think something we talked about before snapped in the market. And all of a sudden, people are really questioning this whole, correlation or coalescence of events that have been on the back of everyone's mind. I don't think it cracks this time, certainly, but I think it starts setting us on stage. Again, I always go back to the great financial crisis. It started breaking in 2006, got fixed, broke again in 2007, got fixed, broke again in 2007, got fixed. So I feel now we've started this unwind, and unless DC gets its act together, this is going to be, every time it rears its head, it'll get uglier, but it's not this year's story anymore.
Pete, love it. Always thoughtful. Peter Cheer there of Academy Securities. If you are just joining us, welcome. Your equity market's still just about positive on the S&P 500, up here by 0.05%. Bramo has thoughts. You know when Lisa has thoughts, don't you? It's that lean. It's that lean. It's at the corner of my eye. I'm just looking at the price action, and it's at the corner of my eye. It's the Lisa lean. It's like, I've got thoughts on that convergence.
I'm thinking about it, and I'm thinking about when will it crack? When will the privilege of acting recklessly sort of run out? Okay. And there's this question to me of a sort of malicious spiral, that if borrowing costs are higher, just globally, if rates are higher, that actually pushes on a string that much more, because that means that interest payments are actually going to be a significant proportion of the annual GDP of this country. That's when things start to change a little bit.
I'm going to listen to nitty-gritty experts. Robert Schiffman is a jewel at Bloomberg Intelligence on credit. He just published Amazon could issue $20 billion more debt but doesn't need to. That's the heart of the matter in this odd time we live in.
That marries both of your views. I mean, you think they can, ultimately they can. Lisa's saying they don't need to, because they don't need to.
I'm going to go Zvi Bodie up at Boston University and say you want to have a balance out there, and at some point, like you said with the CFO of Apple, they'll be opportunistic at what they choose to be the right time.
Michael Dada of Roth MKM joining us shortly. Look out for that conversation. We'll catch up with him in about 20 minutes' time. Up next, Libby Cantrell of PIMCO on the situation in the nation's capital. Live from New York City this morning. Good morning.
Party.
Could face bigger challenges next.
It was going to keep Green World Cup. This is a 3 as the economic picture, covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Daybreak Europe. I'm Kriti Gupta. Let's look to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Playing politics with IRS funding is unacceptable. Cutting it would be damaging and irresponsible. The IRS collects 96% of the federal government's revenue, and this is the funding that enables our country to protect national security, provide Social Security and health care, and invest in our nation's infrastructure.
Treasury Secretary Janet Yellen there speaking in Washington at an event to commemorate improvements in the IRS. Secretary Yellen there. More on that in just a moment. Equities right now on the S&P 500 totally unchanged. Yields going nowhere. 456.66 on a 10-year. We've talked about all that supply coming up later and tomorrow. In the FX market, the euro a little weaker, dollar stronger against most of G10 through most of this morning, 106.70 all morning. One eye on crude, $76 on WTI, down by about 1.5% today. For Brent crude threatening to break below $80 and back into the 70s, $80 and about 40 cents at the moment, Tom. Lower by 1.4%.
Yes, I've been floating the last 20 minutes, but moments ago, like 30 minutes ago, we had green on the screen across SPX, Dow, and NASDAQ 100 is, well, VIX is constructive. I mean, there's some very subtle things here. And, John, again, I'm going to go to the way you opened the show where you said, 6, 8, 7, 8 days in a row of equity joy. It's the quality and character of that equity joy. And like oil, it's just this persistent shift.
On the equity market, inspired by the bond market move, are we still at the whim of what happens in fixed income? What Peter Chi said of Academy about 10 minutes ago, I think is really important. We look at the move in yields and we take comfort from going from 5, he's looking to 430. And then ultimately, he thinks that when you get to 430, you start to think about why yields are lower. And perhaps just yields being lower is insufficient to inspire an equity leg up from here, Tom, and ultimately you have to start thinking about why. And as you get closer to 4, in Pete's mind, you're thinking more about a slowdown in the economy, which becomes arguably less supportive for what happens in stocks.
Totally agree, and the way it feeds in is at the revenue line. If you get lower nominal GDP, this stag disinflation I'm talking about, if you get stag disinflation, revenue growth doesn't happen away from a magnificent 7 that have their own revenue.
All these words on this program, stag disinflation, what was your word?
I'm just trying to keep up.
Devolatilization,
Let's go to devolatilization right now. Amy, bring it up right now. We've got this.
Okay,
this is from Morrison and Boyd Organic Chemistry from a few years ago. Devolatilization. Thanks to our listeners, this is from a guy over at methyl ethylene ketone. Devolatilization process involves the emission of volatile gaseous matters, which are ignited and undergoes a humongous combustion after heated up to a certain temperature.
See?
That's what Lisa meant.
That's exactly what I meant.
That's exactly what Lisa meant when she looked at stocks totally unchanged this morning, Tom.
That's good. Thank you for that from methyl ethylene ketone. Really appreciate your research department. Libby Cantrell joins now. Managing Director, Head of Public Policy at PIMCO. Libby, you're the only one I can do this with. Can you take the election results and you can fold them into a government shutdown, which happens in about 3 cups of coffee? Can you make that exercise happen?
Yeah, well, good morning, and thank you for not asking me a question about Orgo. I did not take organic chemistry at school, so thanks for not testing me on that. Yeah, so I do think that the read-through actually from last night, Tom. So thanks for a layup here. is actually Democrats won a special election in Rhode Island. This is a blue race, a blue seat. This is a House seat. That means that they have 213 seats in the House. Republicans, however, only have 221. They have a special election in Utah in a few weeks. The reason why this actually means this is important from a government shutdown perspective is that means practically that Republicans now can only lose 3 seats. 3 votes in order to pass a funding bill that they need to pass to avoid a shutdown by next Friday. So it just means that the margin of error is much more narrow for Republicans. Speaker Johnson was already needing to thread a needle, if you will, and that needle point has just gotten even more narrow from the results from last night.
In threading the needle, what will moderate Republicans do? I don't have it in front of me, but I'm going to suggest on Long Island, east of New York City, the Republicans had a good night. What are the moderate, I guess the former president would say, Republicans in name only? How do they adapt and adjust off this election?
Yeah, well, I think that what we learned last night is that the abortion rights still very much resonate. That was obviously a takeaway from the 2022 midterms, where abortion really emboldened turnout. It shows last night that this really is very much an issue, especially when it is on the ballot. Now, I think for 2024, many of these folks, particularly in those districts, Tom, that you mentioned, where there are Republicans who are defending Biden districts, the Democrats will make this an issue. You're going to hear a lot about abortion rights over the next year because of the results of last night, just sort of underscoring that this clearly is a resonant voting issue for voters. Now, in terms of the government shutdown, what does that make those moderate Republicans do? They are voting in lockstep here. They really are trying to give Speaker Johnson the benefit of the doubt. I think that will continue. I think the big question for markets is, though, is that enough? Can they actually avoid a shutdown? If they pass a partisan bill, Tom, we will see a shutdown next Friday. So again, kind of an open question of how this all resolves. But as of now, it looks like they are voting in a partisan way, which means that shutdown risk is, I think, is increased over the last week or so.
Do markets care, though? I mean, is a shutdown basically, okay, they're going to do it for 24 hours for effect, and then we'll move on?
Yeah, Lisa, I think that's the real issue. If it is a temporary shutdown, no, this will just be more DC noise. If it's a longer, more prolonged shutdown, it does become, the economic impacts of lots of federal workers being furloughed, not actually collecting a paycheck, could matter. And also, the data matters, right? If we don't get data from the Department of Labor, for instance, that makes the Fed's job, a little bit harder. And we can also see, that this term premium that you all have been talking about, we could see, some of the yields back up again as well on account of this. So I think you're right. If it's a short-term shutdown, no, the markets probably don't care. If it's longer term, however, it may weigh on, again, on just sort of the confidence around sort of the political apparatus in Washington, D.C.
Just shifting from last night's elections to what we're expecting next year in the presidential election, how much of a certainty do you think that it is that we're going to see President Biden versus former President Trump? How much will tonight's debate really color that discussion about potential other running candidates for the Republican Party in particular?
Yeah, so I think what we've been messaging to clients, Lisa, is with high conviction, President Biden will be the nominee for the Democratic Party. This idea that he is going to drop out, that Governor Newsom, for instance, may jump into the race, it just is not. It's just not realistic at this point, nor is there any indication from the Biden camp that he has any interest in dropping out or any intention of dropping out. So he will be the Democratic nominee, again, excluding or assuming there's no sort of exigent health issue or what have you. On the Republican side, President Trump obviously has an incredibly formidable lead in the polls, but this is actually a really important point. His campaign is much more organized, I think, by his own admission, than it was in 2016. And they have been systematically changing the delegate rules in the states in terms of how the state primaries allocate delegates to his benefit. So not only does he have this formidable lead in the polls, but he's also sort of changed the kind of the machinations behind the scenes in terms of how these delegates are allocated. And of course, getting the nominations just a delegate game. So the fact that he's been changing these rules is to his benefit as well. So, I mean, a lot would have to happen, I think, tonight and over the next 2 months. Now, I think what we can show from even last night, that voting behavior is the most important thing to look at, and polls are not always right. And so particularly in Iowa and New Hampshire, Nevada and South Carolina, those are the first contests, Lisa, and how we're guiding our clients is if Trump wins all of those, then he very likely is going to be the nominee. However, if there's somebody contests one of those, then it could be easily become a two-person race. But again, sort of remains to be seen. In terms of tonight, it's really a race for number 2, DeSantis and Haley.
Yeah.
I think we'll see it be pretty nasty and pretty ugly tonight.
I'm looking forward to that debate a little bit later. Libby, thank you. Good to catch up. You're one of the best. Libby Cantrell there of PIMCO.
The auction's at 1 p.m.
Nasty.
Steal up nasty.
Tomorrow.
And then steal up
as
for
well.
the debate.
Is that an actual call or a bit of snark?
Great. I don't know.
Okay.
What
all
do you
right.
think?
No idea. Up next on Bloomberg TV in the next hour, Kelsey Barrow, JP Morgan, Daryl Cronk, Wells Fargo, Jay Poloski, TPW, all of that going into the opening bell from New York. This is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
Bloomberg surveillance, Bramo waiting for the auctions. I'm waiting for the auctions too. Tom Keene and Lisa Bramowitz, John Farrow in deep preparation. Jay Pulaski in the 9 o'clock hour.
Yeah.
Important conversation.
Curious to hear what he has to say about
He's
China in
always
particular.
I was
He
thinking
is.
Duke football, but we'll have to see. Anyways, we're here,
Same
and
thing.
we're coming up on 8:30, except there's no data at 8:30.
There's no data at all this week. I mean, it's a really quiet week after last week's discussion. So if it's quiet, someone's got to fill the noise. It's all the Fed speakers.
The Fed speakers will be there. That's our theme right now. Michael Darter with us. We'll get to him in a moment. But briefing us and getting us to move forward through the week of Fed speakers is Michael McKee. Yeoman's duty last week. He had 3-day marathon, if you will, off the New York Marathon last week. And it's a quiet. What do you do in a quiet week? What do you do? Do you come in and slip in at 9 o'clock?
I wish. I come in and I read research and I look at charts and I listen to Fed speeches.
What's the confidence of the Fed right now among the research that you read? Do they believe in this Fed?
It depends. It's pretty much split. There are the people who think the Fed are complete idiots, and there are people who think the Fed is only slightly stupid. If you're on Wall Street, that's the game, is to say the Fed is wrong about something, pick something. The general view, though, is that the Fed is going to have to cut rates sometime next year, which the Fed had already predicted in its dot plot and SEP in September. It's only a question of when and by how much, and still a question of why. Is it recession? We've got some people, Connor Sen on Bloomberg today, writing, it's time to start worrying about recession. And then we've got people thinking it's, you're going to see inflation go down, so real rates go up, and the Fed will have to loosen to keep from tightening too much.
Here's what I'm struggling with. At a certain point, the Fed officials have just come out and said, we don't know. We're looking at the data because we're not sure exactly whether we're heading toward recession or whether we're heading toward a reacceleration of inflation. So given that, people are kind of ignoring what they have to say with respect to exactly whether yields are too high or where the balance of risks are. What are you listening to, especially with the big three all speaking today and tomorrow in the Federal Reserve, to understand what could shift their view of whether they have some sort of inkling of whether the balance of risks has truly changed?
It's going to take more than just a couple speeches, and I'm not expecting anything this week. I think we basically get a lot of sound and fury signifying nothing. As Neil Kashkari told us yesterday, we've got weeks to go. There's 6 weeks before the next Fed meeting and a lot of data. But what everybody would find the most useful is what data and how much of it do they need to see in order to decide what their next moves are going to be. And that's kind of an open question because the data are always backward looking and they're looking for guidance on what might happen. So they're looking at forwards, they're looking at futures, and they're looking at expectations at the same time that they're looking at the data that comes in, and they want to put it all together and figure out where's inflation going.
They're also watching the 10-year auction today at 1 p.m. where you've got $40 billion being sold. And I say this because Chris Waller, Fed governor, yesterday came out, and John was referencing this earlier, and saying the jump in 10-year yields was an earthquake. We heard this also from Neil Kashkari yesterday when he was speaking with us. He is not clear on exactly why yields have gone up as much as they have and then come down. How much is this a concern to the Fed, that this is truly a sign of market dysfunction?
Oh, it's not a sign of market dysfunction, I don't think. And I don't think the Fed thinks it's a sign of market dysfunction. I think the problem has been that this is an unusual period, and the Fed is trying to figure out where to go with interest rates. They knew they had to raise interest rates a lot, but the market kept pricing in cuts. And then they finally decided to believe the Fed, and we saw rates go way up. Now, there were also hedge funds piling in leverage on short bet on treasuries because of this. And so you get this outsized move that is an earthquake for bond traders, and if sustained, changes the game a little bit for the Fed, but it's not a sign that things are not working.
I said earlier it's Michael Barr Wednesday. To me, Michael Barr is by far and away the most important Fed speaker. He's much more on the financial bank supervision side.
Job, yeah.
What message does he want to convey to a beleaguered commercial banking system?
Oh, I think they would argue, they would push against the idea that the banking system is beleaguered at this point. But what they're looking at now is a series of regulatory changes, one to the Community Reinvestment Act, and two to essentially Dodd-Frank and the Basel regulations. And those take about a year to implement. They have to put them out for comment and stuff. So he's out explaining what they're doing and what they're trying to do and trying to win support for that. Interesting discussion came up overnight about whether we should see the non-bank sector. The CFPB is talking about putting more regulations in place for the shadow banking system. And that's going to be an issue going forward. When you talk to Fed officials, the one constant they say is that we don't have enough window into what is going on in the shadow system. Therefore, we could have a problem there and we wouldn't know it.
Michael McKee, thank you so much. Lisa, I'm afraid to ask, how many Fed speakers tomorrow?
Well, we had the big ones, right? And we have at that IMF panel, as you were mentioning, we do hear from Fed Chair Jay Powell in a more comprehensive, moderated speech.
Saving us, Michael Daugherty here with Careful Conversation, Chief Economist, Macro Strategist, Roth, MKM. Michael, you know where I'm going. I need a calculation of the two moving parts of the DARTA nominal GDP. I got a real economy gyrating around, and I got some form of disinflation gyrating it down. Define the DARTA nominal GDP into 2024.
Thanks for having me on, Tom and Lisa. Look, Tom, I don't think anybody's talked about this morning yet, but there's actually a metric in the monthly job statistics called average weekly payrolls. It's a really clumsy title for basically the sum of wage growth, job growth, and hours worked growth. And that is really close proxy for nominal GDP. So real growth plus inflation, total spending in the economy. That printed 0 in October. Not only that, you have the unemployment rate that's moved up to 3.9%. From a cycle low of 3.4% seen in April and in January. Over a 9-month interval, we've never had a 0.5% move up in the unemployment rate that was not associated with a business cycle peak or an economy already in recession. So essentially the proxy for nominal flat lines in the unemployment rate at least is giving us, I'd say, a soft recession signal. And I think that can tell us a lot about why the bond market is rallying here.
Michael, that's the first chart I looked at this morning, folks. This idea of how low did the unemployment rate go, and as Mr. Darda mentions, up we go to near 4%. I would suggest that we've got a new regime, sort of as we look at a new regime of our starter where the Fed's going to land a monetary policy. Do we have a new regime in pure U3 unemployment rate? Is, for example, 4.3% the new 5% unemployment?
Well, it would be unprecedented in the sense that anytime you go up half a percentage point, you continue to rise. With a cumulative rise during a recession of at least 220 basis points. Usually it's a little bit more than 300 basis points in total. So if we end up with a situation where the unemployment rate just goes a little bit above 4 and stops, that's possible, but it's literally unprecedented. So typically when you start to see the unemployment rate hook upwards, it continues for a while. It signals a recession that isn't recognized right away. And if the neutral interest rate, R-star, starts to fall here because the economy is rapidly losing steam and the Fed is reluctant to follow suit, that's how you end up in a recession hard landing. And I think that would end up reinforcing the message that the yield curve has been sending now for well over a year, a long leading indicator along with monetary growth, along with the tightening in lending standards. We got another iteration of that yesterday out of the Fed Senior Loan Officer Survey. So all of the leading indicators have been suggesting that we're getting long in the tooth here in terms of the business cycle, and that recession risk is still elevated, even though the consensus view on Wall Street now is that the soft landing's in the bag. It always looks like a soft landing just before a recession. Trend growth is an oasis to below trend growth, and below trend growth means the unemployment rate is going up and you have a recession.
That said, a lot of people would point to recent earnings and say there are so many companies that are beating expectations, that are raising prices and increasing volumes. Think about more expensive Macs and all sorts of burgers and Starbucks drinks. How do you push back against that? The corporate America story that has been told in earnings.
Yeah, no doubt about it. Good point. So there was a fear that earnings would just crash this year, and that obviously has not happened. But if we look at forward-looking earnings, the 12-month forward estimates, they've essentially gone nowhere since the summer of last year, yet the equity market multiple is up 3 points. And bond yields, even after this rally in bonds and the drop in yields from the highs of the year, are well above where they were mid-year last year. So the equity market has become more expensive in absolute terms and more expensive relative to fixed income. So I think we have, high hopes here that the business cycle is going to be sustained, and eventually, we go back into a upward profit cycle. And I think those hopes are going to end up being dashed.
How much do your clients push back against you, saying everyone was worried about recession 1 month, 2 months, 3 months into 2023 and just kept being wrong? And so why is this time different when you do look at all this strength out there?
Yeah, it's interesting. I think there's quite a bit of confusion out there in terms of the money management community. I mean, certainly some folks have been, quite bullish, and it's been, a good year if you're bullish on equities, if you're just looking at the broad indices. But it's been a very narrow move upward in the S&P 500. We really haven't done much in terms of an equal weighted index, and obviously you guys talking about the small caps underperforming, and some of the the groups that are tied closely to the economy and cyclical value really struggling. So I think it's more confusion out there than like tremendous conviction. And look, forecasting is a tough business. When the yield curve went into inversion, we started to get a lot of leading indicator weakness. Our view was if you just go with the historical parameters, you would look for a recession sort of mid-year into the fall. And certainly that looked wrong when you had this huge GDP print in Q3 and this rip-roaring equity market rally in the S&P, even though it was narrow this year. But yet, as I mentioned earlier in the segment, we could be on the cusp of a business cycle peak here. So, we haven't really written the entire story just yet. So we'll see how it unfolds from here. But there's certainly room for debate. There always is.
Michael Darda, thank you so much. With Roth MKM. Green on the screen, futures up 3. They sort of stayed there all day. NASDAQ floating around a little bit of red with the NASDAQ. On the S&P 500, we're up 0.2%.
There's a story that caught my eye. We've been talking about the strength in the labor market, Tom. This is the latest. American Airlines is looking to offer $250,000 bonuses to pilots from FedEx and UPS who ditch those employees and employers and go to American Airlines.
A number of people, including Helene Becker, have been way out front on this story. I have trouble with it when I'm on a smaller plane and the kids getting on, I'm like, can they drink at a bar? You
don't think that the pilot is old enough to do anything?
Building.
Got it. Well, this has been the issue, is that how do you get these people in? And if you don't have them, it becomes a real revenue drag, considering that you have to ground planes and cancel certain flights. And so you're seeing these incredible bonuses being offered.
Yeah, I think every industry is different. And I think the amalgam of, as Mr. Darda talked about, is we're still at a very low unemployment rate. I'm not sure I know what a high unemployment rate looks like anymore.
I don't think anybody does. I think that's a really good point, especially given that it does tend to be asymmetric on the way up. But to what? And that actually matters quite a bit.
To what is to the auctions this afternoon. Stability on the tape right now. West Texas Intermediate 76.68 after printing is 65. We have the Bramall countdown clock, and we're a solid 4, 5, 6 hours, whatever it is, from the auction. What actually happens at 1 or 2 p.m.?
Well, at 1 p.m.
There's like a press release?
Yes, and they release the results, and then there's the trade immediately after the bonds are issued to the primary dealers, to the direct bidders, to the indirect bidders, and then they put out all the technicals to understand exactly what happened.
Stay with Bloomberg Surveillance.
I can feel you
1
falling
p.m.
asleep.
this afternoon. Our special report, The Treasury Decides.
Okay, stop.
Good morning.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Next week on AI IRL.
It's talent that drives, this innovation, and talent still concentrates around a small number of physical places. I do think China is going to catch up. I think they're going to develop their own AI chips, their own fabrication facilities, but that is going to take 5 years or so. The export controls that the US has implemented, are real.
Take a step back and look at the inflation readings more broadly, it still looks like we're trending toward 3% as opposed to 2%. We thought growth would start to slow before and been surprised by the overall resilience. So I think that we're going to continue to need to see tight financial conditions in order to bring inflation to 2%.
Lori Logan, Dallas Fed president, saying what a lot of Fed officials have been saying recently, which is they have all been surprised by the strength of the U.S. economy. Welcome back. This is Bloomberg Surveillance. John's off preparing for the 9. Tom Keene, Lisa Abramowitz. Tom, I think it's just amazing to see the sort of overlay of gloom, as you put it, on top of earnings that have actually been pretty decent.
The earnings have been pretty, I'll go with that. But I think in what we're going to talk about here in commercial real estate is just flat out gloom. And what I'm doing, folks, and I don't know about the rest of you across this nation, but I'm reading every single real estate transaction article I can. People love to talk about this, but the fact is they're coming fast and furious right now, and that adds to maybe a templated gloom.
I'm looking forward to the conversation. Just quickly to give you a sense, not just of headline where the index levels are, but some of the names moving beneath the surface. Warner Brothers, we were talking about this earlier, how they came out and they did disappoint in terms of a third quarter loss that was bigger than expected. Free cash flow is still stronger than the expectations, yet still those shares getting absolutely hammered, down almost 10% ahead of what we're expected to get after the bell with Disney.
I didn't see that, and that 10 level on Warner Brothers is key. I mean, if I just do a quick chart here, I'm down to $9.53 as a low. So that's really coming back. I'm going to call that a huge disappointment.
And there's this real question around how much stocks are getting punished for missing much more this cycle than in previous ones. New York Times shares are up because they did report a better subscriber growth than expected. This is something to watch. New York Times up about 6%, 5.74%. But I wonder how much you start to see consumers coalesce around the idea of actually paying for subscriptions, especially for the cooking and the Wirecutter and the other types of services from the likes of the New York Times. And Roblox popping more than 16% after reporting bookings that beat estimates. And to me, I thought that was really interesting just because everybody left this company just a few months ago for saying maybe it was just a blip during the pandemic. And now it looks like maybe not so much.
I would just have to see. I think it's story by story, and what I see is a resilient bid. I mean, I would think within the swirl this morning that we'd have futures down, a nice amount, and this is day after day now. They're just not. That's no other way to put it.
And it's the longest streak of gains on the S&P going back 2 years. We have been talking about WeWork and the potential ramifications for commercial real estate around the world, but particularly in the New York and San Francisco markets. Joining us to talk about just how bad of a time this is for this to hit, Alexander Goldfarb, Senior Research Analyst at Piper Sandler. I want to start there, Alexander. There have been discussions around the number of leases that WeWork is going to abandon. Is the pressure on commercial real estate, office space in particular in New York, is it overstated right now or understated?
Well, good morning, Lisa and Tom, and thank you for having me on. Here at Piper Sandler, when we look at what is going on in office, it's eerily similar to what happened with malls, over the past decade. If you recall, everyone pre-pandemic thought every single mall was going to close because everyone was going to shop online. And in fact, what happened is the dominant malls like the Roosevelt Fields or Houston Gallerias continue to excel and lesser malls fall away. The same thing is with office. So if you look at WeWork, which we don't cover WeWork, but if you look at some of the fallout out in San Francisco, they rejected a bunch of leases. They did not reject one lease from Boston Properties. When you look in San Francisco, when you look in New York, companies like SL Green, Vornado have zero exposure now to WeWork because they exited those WeWork leases over the past number of years, and even Boston Properties only has 1%. So when you look at the fallout that's going to happen, and you look at the major REITs, and especially the ones that we cover here at Piper Sandler, the impact is negligible. And what's really interesting is when you look at office, especially here in New York, it's gravitating around Grand Central, and actually you're seeing rents increase on Park Avenue. So just like malls, the dominant office will survive. The lesser, the generic office, that's where the trouble is.
So are you saying right now that the prices have baked in a lot of that trouble, or that people just haven't been discerning enough to understand the winners versus the losers?
Absolutely. If you speak to the brokerage community like Newmark, they and Cushman and the other brokerage companies are starting to discern the difference between top tier versus generic Class A, Class B, et cetera. So when you look at what tenants want today, tenants want, great space with a lot of amenities, convenient for commuters, and they want a landlord who has the capital wherewithal to invest in the properties. And let's face it, the brokers want to get paid a commission. And you're seeing that fallout. It's no different than we've seen in retail. So again, I use the mall example. Simon Property Group, with their $1 billion a year free cash flow, tenants know that they can be there. The same is happening in REITs with companies like SL Green.
It's right where I wanted to go. Alexander, you're reading my mind. What is David Simon going to do with this? Folks, Simon Property Group, Indianapolis, 3,000 employees. What is the guy from Indiana University can do? He's seen this before. We come down, but my history is fresh money always comes in. When does the fresh money click in if transaction to transaction I'm down 40%?
Well, you are speaking David's mind. He loves cash flow. So since IPO, the company has paid out $39 billion in dividends. And the reason they've done that is by investing shrewdly. So when you look right now, he's very focused on investing in his malls. So apart from the Taubman acquisition, which was structured before the pandemic, he hasn't bought anything on the outside. His focus has been investing in the malls, like out in Northgate in Seattle, where they're converting it into a hockey arena, or Houston Galleria, where they're adding office and apartments, et cetera. So that's where he's focused. But let's face it, given the challenges away from Simon, he can pick and choose. But if you look, he's making a ton of money out of his portfolio, which people forget is actually small. It's only 120 malls and only 200 or so domestic properties in total. So he's a large company, but with a small powerhouse portfolio.
Right. But Alexander, I got to make some headlines here. We're in the business of news. Alexander, there's blood on the streets. We see it in New York, and I get it. New York's its own little weird place, but there's all across the nation real estate blood on the streets. Are you saying your world of REITs, back to when you were at Lehman, your world of REITs, is it now a screaming buy because of all the agony Lisa was just framing?
So it's not a screaming buy in the sense that interest rates are high, right? We have a 10-year that was approaching 5%. It's now backed off a little. But certainly the financing market, which, as you guys have reported, is basically shut down, right? CMBS market is tough. You walk into a bank and try to get a construction loan, they'll call the cops on you. They're like, we don't do that right now, right? So lending is very tough. The transaction market is almost on ice because of the widespread. What's interesting and people miss, and Tom, you're like my first boss at Lehman, David Schulman. You've been around a number of decades. Real estate right now is benefiting from a phenomenon that it has not had in a long, long time, which is low supply, because nothing new is getting built, and low vacancy. That combination is really powerful. And you started the show by saying, how is the credit going to get worked out? Again, as we've spoken before, back in the GFC, everyone was panicked about the CMBS. No one can tell you where the benchmark GG10, what happened to that famous 2007 deal, right? Stuff gets worked out. Obviously, there will be pain. There will be blood for sure. But if you look at real estate's biggest benefit right now, it's that lack of supply and low vacancy. Right. That's a huge positive that is underappreciated by the market.
Just about 30 seconds. What happens if there's forced selling, akin to WeWork?
So WeWork is a tenant, so you don't really have forced selling from that. But to be clear, banks, where everyone's focused on, they're not in the business of running real estate, right? So as long as it's a good asset with a good sponsor, they're going to work out some deal, because as the old adage goes, a rolling loan collects no loss. That said, there's clearly going to be assets that will go back to the lenders, and those are the assets where the economics don't exist. That's the stuff to worry about. But the big properties like the 399 Parks, the One Vanderbilts, those big centers are going to be fine. And again, when you look at where the value in real estate is, it's accruing at the top. Okay. But you're right. There will be blood, and the blood is going to be from generic assets.
Alexander, brilliant. Alexander Goldfarb, years of work at Piper Sandler now on real estate investment trusts. I took notes on that. That was
fascinating. Where it's been priced in and where it hasn't is interesting.
It is an extraordinary day. West Texas Intermediate, $77 a barrel. Please stay with us on radio, on television. Bloomberg Surveillance.
So you told your mother you'd like to go to Africa and see the chimpanzees, and what did she say?
Not the chimpanzees. I would have studied anything.
Well, what did your mother say to anything?
If you really want to do this, you're going to have to work really hard. And if you don't give up, hopefully you find a way.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
That's me, Max. What's up? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Like, please, like, really actually tune in. I desperately need an audience.
Seven-day winning streak on the S&P 500. Live from New York City this morning. Good morning, good morning. Equities just a little bit higher on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, equities on the longest winning streak in 2 years. Looking to see if Chair Powell spoils the party as the Treasury braces for another big test. We begin with the big issue. Will Chair Powell spoil the rally?
Markets have sort of reset their expectations with how much of a headwind central banks are going to be.
The stock market rallied because the bond market rallied.
This move has been a well-deserved sigh of relief.
There's a bit more reason for investors to be a bit more optimistic.
At the same time, we're seeing that interesting dynamic where central banks are actually not that happy about it.
It might complicate the Fed's process for trying to rein in inflation.
Financial conditions need to remain fairly tight for them to achieve their goals within a timeline that's acceptable.
The Fed is going to maintain this message of higher for longer, which means higher for longer.
They allegedly aren't even talking about rate cuts.
They're not even thinking about rate cuts at this point.
We are seeing some evidence that the economy is indeed slowing.
Inflation is back.
Inflation's not where it needs to be yet.
I don't think any central banker will want to declare victory on inflation.
The Fed needs to be very, very cautious.
Joining us now to discuss JP Morgan's Kelsey Barrow, Darryl Cronk of Wells Fargo. Kelsey, first of all to you. We'll hear from Chairman Powell a couple of times in the next 24 hours. Are we expecting another rendition of 550 ways to proceed carefully?
So I don't expect a lot of changes from Chair Powell's message today or later in the week. The Fed is data dependent right now. I mean, they're focused on inflation. They're focused on the jobs data. So here's what I would say. The market is going to trade a soft landing until proven otherwise. The Fed, on the other hand, they're going to be focused on, is inflation continuing to come down and is job growth continuing to moderate? The September payrolls report was a real cliffhanger. There was a question around, is job growth actually reaccelerating? I think the October jobs report last week really built some resolution into that question. The jobs market is still cooling. Job growth is still slowing. The unemployment rate is actually ticking up. And on the inflation side, I was noticing the New York Fed's global supply chain pressure index. It's at the lowest level in the history of the index, lower than it was at the GFC. So as long as inflation continues to come down and the jobs growth continues to moderate, we're in a soft landing until proven otherwise.
Kelsey, Neil Dutta, Renaissance Macro, said the labour market no longer a reason to be hawkish at the Federal Reserve. Would you agree with that?
The labor market, you said?
Yes.
I would agree. I think you've been seeing signs of cooling in the labor market now for a number of months. The unemployment rate is gradually rising. Job growth is gradually slowing. You know, some of the other things that I look at under the surface, hours worked. So if this is an economy where companies are more concerned about laying off people that they spent a lot of time and effort to hire, you're going to see the weakness in the labor market come from hours worked rather than layoffs. And that's actually what you've been seeing. Hours worked has been declining. And also those temporary jobs, temporary help services has been very weak for a number of months. So I think the Fed can feel good about this moderation in labor demand and supply continuing.
Darryl, just to build on that, to Kelsey's point, in the labour market, we have seen this ongoing rebalancing. in your mind there, do you think this Federal Reserve is willing to tolerate the easing of financial conditions we've seen over the last week?
Yeah, it's a good question, John. I would say, look, the central bank, and particularly the Fed, I think is agitated right now. I think they wanted to deliver a message of a hawkish hold last week. The markets interpreted it as a dovish hold, basically. If you believe that the yield curve was doing the work for the Fed in additional hikes, then as rates come down, you have to also concurrently believe that it's not doing the work of the Fed anymore. So I'm not convinced the Fed is fully done yet. What I am convinced of is the market has far too many cuts priced in for 2024 at this point. We just don't see that happening. And if you think about it and you reverse engineer this, the fastest way to rate cuts from the Fed is what? A recession, right? And so this idea that soft landing sits side by side with aggressive rate cuts next year, or even rate cuts, period, is not something the Fed's considering. I think, to be candid, John, I think 2023 was all about inflation, was the straw that stirs the drink, and Fed rate hikes. 2024 is going to be all about the performance of the real economy and where it goes.
Well, you say too many rate cuts are priced. Kelsey Barrow, 2024, are too many rate cuts priced?
I'm not sure that too many rate cuts are priced. I understand the concept that if the economy continues to show resilience, then the Fed is going to continue to communicate that policy should remain restrictive. But the market prices things on a probability-weighted basis. So yes, there may be a 50%, 60% probability that the Fed can stay on hold all year, but there's also a probability that you get a recession. And in a recession, we know that the Fed cuts very quickly. So I actually think that there is justification for the market to be pricing in some cuts next year. And then when I think more broadly about what the Fed funds futures curve looks like, it actually shows that a Fed that isn't going to cut rates below, let's just say 375 for the next 10 years. I actually think that's quite sanguine. I think the market is still sensitive to higher interest rates. And ultimately, I don't expect that type of sanguine view for the policy rate to stay above 4% for the next 10 years is really likely.
The bonds are fairly stable this morning for once. On a 10-year at the moment, yields just about unchanged, down a basis point. Let's call it 4.56 on a 2-year. Up a single basis point on the 2-year right now. We can call it about 4.93. Tons of Fed speak on the calendar. Mike McKee, we'll hear from Chairman Powell today, right? And tomorrow again.
Yes, we will. Will it make any difference? That's an interesting question. Your guests have been highlighting the difference between the bond market and the Fed. To talk about that, I'm going to point out that the bond market has now priced in a very aggressive cuts, as you say, and I can explain it through the words of one of the greatest coaches in Premier League football history, Ted Lasso, who said, you know, the happiest animal in the world is the goldfish. It's got a 10-second memory. Be like a goldfish. That's the bond market right now with the data and Fed speak. Because you look at what the Fed has been saying, and it's completely the opposite. Neil Kashkari sat down with us yesterday and said, 3 months of data may not even be enough to convince me of where we are and where we're going. And several other Fed officials yesterday gave essentially the same message. It's a very, very uncertain time, and they don't know what they're going to do yet. And so all this gyration that we're seeing in the markets doesn't mean very much to them. There is one point that is also addresses both of those, and that would be Deutsche Bank's Henry Allen noting that this is about the 7th time now since the Fed started raising rates last year that the bond market has pivoted in its expectations of the Fed. And this time it's because they're thinking, well, we've gone down and now that's going to loosen financial conditions and that's going to make the Fed's job harder. So do you want to be a goldfish or not? Maybe not. The Fed is going to be looking at all of these data points coming up, and they're going to look at the longer run horizon more than 10 seconds. So it's a long way of saying maybe we don't want to worry too much about what the bond market's doing right now.
Mike McKee, thank you, sir. I'm so pleased you did that. Darryl Cronk, Jim Caron, Morgan Stanley on this program yesterday talked about how quickly we've gone from the big bad wolf in the bond market to Goldilocks, just like that in a week. How quickly can this narrative, Darryl, flip back?
I think very quickly. I mean, the reality is you had a lot of hedge fund and CTA positioning that was offsides, net short, that had to cover quickly when we broke through some technical levels last week. The long side of the yield curve created the equity market rally. Looks to us like it's a bear market rally and not something that's sustainable. Remember, the cause of last week's rally on both fixed income alongside the curve and the equities was a less than anticipated QRA coupon funding, you know, a Fed that was perceived dovish when it should have been perceived hawkish, or hawkish hold anyway, and frankly a weak unemployment number. So I think you can unwind this very quickly. And I just would remind everybody, John, that, you know, yes, it was a huge move last week, but we're back to exactly where we were on interest rates and on equity levels when we were in mid-October. So literally a couple weeks ago. We've done nothing but round trip this thing from the big bad interest rate move on the 10-year to 5% back down to 460 this morning, which is where we were on October 15th, 16th, 17th.
Kelsey, what can you point to that makes you think this move is sustainable?
So at least as it relates to the rally in yields, the move lower in risk-free rates, I think that this is sustainable primarily because we do believe that the Fed is done hiking. Now, I don't expect that central bankers at the Fed are going to admit this anytime soon, but I do think that the trends in the things that they care about the most, the inflation trends and the labor market trends, are supportive of them keeping policy rates restrictive, but not necessarily going higher from here. And we do know that in an environment where the Fed is able to sustainably pause, we should be seeing yields moving lower, because if the next move isn't up, then we're thinking about when the next cut is going to come. And I know that the Fed is not talking about cuts yet, but we also know that the market moves very quickly. And right now, we've seen a lot of resilience in growth, particularly Q3. It's all being relied upon the consumer to hold that up. If we start seeing those cracks in the consumer show up more readily, that's when I think the market will get more nervous.
Well, Kelsey, to that point, your long-running call for lower yields, does it require from here, not just rate cuts, maybe next year, but ultimately materially weaker economic data into year-end and beyond?
So I don't necessarily think you need materially weaker data to get stability in yields and a drift lower in yields, but to get a real reaction from the Fed where they're no longer on this more neutral to hawkish bias, but they're actually thinking about easing policy, yes, you need to see non-farm payrolls falling below 100,000, and you need to see the consumer starting to struggle. We're definitely seeing that under the surface, particularly for lower income, younger cohorts. Delinquency rates are not just rising back to pre-COVID levels, they're actually drifting above pre-COVID levels. But overall, if we're not seeing that in the macro data, you know, we're not there. And so for now, it's a soft landing until proven otherwise.
So, Daryl, it's a soft landing until it's not. And this is what Peter Chia of Academy Securities was talking about earlier on this morning with us on Bloomberg Surveillance. He thinks there's a 3-week window here, maybe a month, where you can be constructive. And ultimately, perhaps yields can move lower from here down to 430. But his point is the following, that you can take some enthusiasm and constructive view from a shift lower in yields, but at some point you start thinking about why they're lower, why we're talking about rate cuts. And ultimately, it's got to be because the economic story is not as good as it once was. Does that mean for you, Daryl, even if we do get this continuation and a move in the bond market that we've seen over the last couple of weeks, at what point does that start to become negative for the equity market and not positive?
Well, if yields do move substantially lower from here, or even marginally lower from here, I think it is on weaker data. It is this narrative that, you know, bad news is good news right now, but eventually bad news becomes bad news, right? When the economic conditions soften materially. It's normal, if you go back long-term in history, John, to see U.S. 10-years trade about 200 basis points north of CPI, of inflation, right? So even if you're going to assume CPI at 2.5%, right? You should have a 10-year around 4.5, maybe 4 3/4, somewhere in that range. We're where we should be right now. Above 5% moves from, I would call, restrictive conditions to punitive conditions for the U.S. economy. In this range here, I think we can live with this. But what's interesting is, you know, if you take the narrative of the third quarter earnings season, you know, you're getting 1 to 2 sales growth, so not really any top line sales growth, and you're getting all your beats and sales growth on margin improvement, which means companies are being disciplined about cutting the expense line on the equation, but you can only pull that lever so long. Eventually, you need to see that pricing power take back over, which is a problem for inflation. And I would remind our listeners, if you simply looked at average hourly earnings and wage inflation, which doesn't have a lot of the recent increases in it, it's still running at 4.1% year over year, way hotter than the Fed wants it to be.
10-year right now, 4.56. Darryl Kelsey, stick with us going into the opening bell. About 20 minutes away, 17 minutes away. Your equity market slightly positive by 0.1%. With some movers going into the open, here's Katie.
Well, let's start with Take-Two Interactive. It is soaring this morning after its division Rockstar Games said that it will release the first trailer for the next version of Grand Theft Auto in early December. Take-Two also reports after the bell today, so watch this space. Moving on, Rivian higher as well. After modestly boosting its production outlook, it also ended its exclusivity agreement to sell its vans to Amazon. Traders clearly see that as good news. Bad news, though, when it comes to Robinhood. After earnings, slow trading volumes led to a miss on estimates. Fourth quarter guidance was a disappointment as well. You add it all together, Robinhood down about 7% pre-market, John.
Katie, thanks for that. Coming up on this program, annual debt interest costs could be topping $1 trillion in the United States.
The bond market, in some ways, is the risk asset, and the stock market is secondary. And set against the fiscal backdrop, I think it's altogether dangerous.
That conversation up next.
Kenyan athletes are getting better and better, and their times are getting quicker.
Agnes Tirop takes the win and the world record.
With all the success, there also is a dark side to it. And this comes about when men in the community look at women as prey.
The sport fraternity is in mourning tonight. Our world beater Agnes Tirop was found dead today. When you're moving into the career of athletics, you have to carefully look at who are the important people in your life. Even in a partnership, it can move into manipulation.
A lot of people let Agnes down. She felt that the threat was real. What she was told is exactly what happened to her.
The bond market, in some ways, is the risk asset, and the stock market is secondary. And set against the fiscal backdrop, I think it's altogether dangerous. I'm not inspired by the fiscal dynamics. You mentioned numbers like $1 trillion in interest expense, and that's only going up from here.
The Treasury issuing a ton of debt this week with $40 billion of 10-year notes today, $24 billion of 30-year notes on Thursday. This, as Bloomberg analysis shows, estimated annualized interest costs on the U.S. debt climbing past $1 trillion. The numbers could well get worse, likely reigniting debate about the U.S. fiscal path. Bloomberg's AMH joins us right now. Morning, Anne-Marie.
Good morning, John. Well, when you're looking ahead, it does look like when you see these yields rising on long-term treasuries, what this could mean is an escalating and bigger interest payments for the U.S. government. And I'd like to bring you what the Congressional Budget Office has already been putting out. to talk about what the future is going to look like in terms of the U.S. federal budget. By the year 2051, Jonathan, paying our interest will be the biggest expense of the budget, ahead of Medicare, ahead of Social Security, ahead of our defense bill. And actually, when it comes to paying down the interest, in just a few years, that's going to be a bigger share of the spending as opposed to the massive U.S. defense budget. So obviously, this potentially could cause some concerns on both sides of the aisle. And we're seeing some of this play out right now as we do see the House of Representatives try to negotiate some sort of way to keep the government open by next week. Come Saturday, 12:01 a.m., Jonathan, November 18th, the government may close if there's not a continuing resolution. And a lot of conservatives are saying that they want to see fiscal spending and fiscal discipline, and that's why they want appropriation bills passed, but it doesn't look like there's going to be enough time for that. So potentially we'll get another stopgap. But this issue of long-term interest payments and that eclipsing everything else in our budget is starting to come back in focus.
AMH, thank you. The number's getting bigger. Let's catch up later on this. Kelsey Barrow, Darryl Cronk back with us for more. Kelsey, 40 billion, 10-year notes later, 30-year bonds tomorrow, $24 billion worth. Should I be worried about that at all?
Well, certainly the auction today and the auctions tomorrow are going to be a test of the market's ability to take down this much duration. And the trend that we've been seeing throughout the year is that the demand for treasuries has been shifting in terms of who's taking down that duration. It's shifting away from the price insensitive buyers like the Fed, like the banks, and moving towards more price sensitive buyers like asset managers, like we are, that are going to be more discerning about the yield and compensation that they demand to take on that additional risk, that additional duration risk. Now, I already mentioned that I was a bit skeptical about the path for the Fed funds rate, with the Fed funds rate never falling below 3.75% in the next 10 years. This plays into it. I think one of the reasons why the economy is going to be more fragile under a higher interest rate regime is also not just for corporations and for consumers, but also the strain that it puts on governments. We have a very difficult situation ahead. In the near term, we may be able to manage it. I think the auctions are probably going to be fine, but this obviously is going to be a focus in the coming weeks, in the coming months. And the challenge is that we know that markets really focus on what's just right in front of them. So we know those projections, that chart, interest expense is rising, but for now we have to focus on just what the event is in front of us. We have the 10-year auction, the 30-year auction, and then of course the risk of government shutdown, which is difficult in its own way because we lose access to all of the data that the Fed relies on to make decisions.
A good friend of ours on this program, Rick Reeder of BlackRock, had this phrase that he used with me a long, long time ago. He said, we always focus on the shark closest to the boat. And this right now seems to be the shark closest to the boat. Darryl, in your mind, I'm sure you get asked about this from clients all the time. They ask you about the deficit, the debt dynamics, interest costs. What do you say back to them, Darryl?
Well, I would say a couple things here. I mean, the bid to cover has been good on the auctions. I think it'll continue to be good, but there's no doubt that banks, overseas buyers, and institutional buyers have been dented by poor fixed income returns on the long side of the curve, which are typically your duration buyers. So the mix is shifting. We'll see how well the market absorbs that. I would say this, John, 3 $1 trillion numbers, different numbers that you should have your eyes on. Certainly the interest cost going to $1 trillion, up from $399 billion on the CBO's estimates, is meaningful and matters going forward for the path of interest rates. Second, people forget that quantitative tightening now year over year has the Fed's balance sheet down almost exactly $1 trillion, right? So that's tightening financial conditions, and it's adding to bond market volatility, which is why we're seeing extreme moves here in interest rates, because the Fed's not an active buyer anymore through QE. In fact, they're letting things roll off. And the third one that people don't talk enough about is the $1 trillion of outstanding credit card debt that's out, that's out there, 1.08 to be exact trillion dollars. So $3 trillion numbers that matter here: interest costs, the Fed shrinking its balance sheet, and credit cards outstanding. At some point, those start to weigh on economic growth and opportunity.
Thoughtful stuff as always. Darryl Cronk, Kelsey Barrow, thank you. Sometimes the news is that there is no news. Mike McKee has the news that's no news. Mike McKee.
Jay Powell's text is out for his remarks this morning. I know the markets were looking forward to perhaps some sort of hint to monetary policy. Absolutely nothing in there. You can put that one aside unless you're really into the history of the Research and Statistics Division of the Federal Reserve. He gives a history lesson there. But tomorrow he does speak at the IMF with Gita Gopinath and with the Israeli Central Bank governor. And so that is an opportunity for him to perhaps push back if he wants to on the markets.
Mike McKee, thank you, sir. Looking forward to tomorrow. Coming up, the morning calls and later, stocks continuing to climb the wall of worry. Big tech looking for a 9th day of gains. Jay Pawlowski, TPW, coming up next.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Equities drifting just a little bit higher, turning positive going into the opening bout. That's the price action. Let's get you some morning calls. Citi downgrading NXP Semiconductors to sell, seeing risk to estimates due to weakening demand. Mizuho downgrading Datadog to neutral, expecting limited upside after yesterday's monster rally. And finally, TD Cowen downgrading Estée Lauder to market perform, pointing to softening China trends and lingering supply chain disruptions. That stock is down another 1.4%. Coming up, stocks looking to extend their longest winning streak in 2 years. That conversation up next with TPW's Jay Pawlowski. Your opening bell is up next.
the EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
It's 23 seconds away from the opening bow this morning. Good morning to you. Equities higher again on the S&P by 0.1%. 7-day winning streak on the S&P 500, 8 on the Nasdaq 100. Over the last 8 days on the Nasdaq coming into Wednesday, a move of more than 8 percentage points. Stellar rally going into the opening bow. There is your opening bow. Switch at the board and get to the bond market. Big move lower in yields off the multi-decade highs we saw a few weeks ago on a 10-year. North of 5%, back to about 450, 456, 66. The dollar stronger against the bulk of G10 through most of this morning. 106.73 on the euro against the dollar. That currency pair moving lower by 0.25%. We are going to talk about crude later in this show in about 15 minutes' time. To see WTI in the 70s, a move lower of more than 10% in the month of October. We're back to lows we haven't seen since July. WTI crude $76 and about 70 cents. 30 seconds into the session, we're positive again. We had some more weight to the rally on the S&P 500, just 0.17% higher. One stock to watch at the open is eBay, the company delivering a disappointing outlook and sounding the alarm on consumers, saying this: we've observed softening consumer trends, suggesting we may see a more muted seasonal uptick over the holidays. Katie has this story. Hey, Katie.
And it's that grim holiday outlook that is sinking eBay shares this morning. Specifically, eBay sees EPS between $1 to $1.05 in the period ending in December, obviously a crucial period. Now, analysts had been looking for $1.05, so at the top end of the company's range. That's not good enough in this earnings season, as you can see in the shares right now. And like you said, the company was quick to place the blame on the macro environment, but this is also a story about losing share as much as it is about consumer health. Overall online spending in the U.S. is actually continuing to grow here, but eBay, it's battling the likes of Amazon, the likes of Walmart for those dollars, and that's an increasingly tall order. You add it together, shares currently off by about 7% or so, and negative for the year overall, John.
Katie, thank you. Not a great morning for them, that's for sure. Not a great year either. Katie, thank you very much. A tale of two earnings stories in the auto sector. Rivian raising its production forecast, Lucid cutting theirs. The Rivian CEO saying this: I just want to state how deeply convicted we are that the entire auto industry will be transitioning to electric over the next 1 to 2 decades. Simone, does he need convincing or do we?
Well, I think the real convincing is going to come in who is the follower to Tesla. Who's the front runner to be that follower to Tesla? At least in the earnings reports that we got after the bell yesterday, it looks like Rivian is far better positioned than Lucid to take up that mantle of number 2 EV maker. I mean, you look through these results, Rivian able to boost deliveries of for the year to 54,000 trucks and vans. That's up from 50,000 in in August. It had already boosted that by 2,000 between then. Also, the company ending an exclusivity agreement on battery electric vans to Amazon, so now they'll be able to sell to other players as well. They're also going to do an interesting tech upgrade to cut manufacturing costs. The CFO saying these changes will, quote, position Rivian to exit 2024 with a much improved margin profile. Looking at a much more negative picture for Lucid, which makes luxury in electric vehicles, lowering its projections for the year in terms of deliveries to 8,000 to 8,500, down from 10,000. Not entirely unexpected, but investors have been really worried about some of the cash burn going on there, especially after it raised $1.5 billion in private debt last month, and the results here coming out not helping those concerns, especially at a time that electric vehicles are just a lot more expensive given high interest rates. So control of costs, staying on production targets, that is what is putting Rivian ahead this morning, and shares going in completely opposite directions here, John.
Hey, Simone, thanks for the update. Let's check out shares of Robinhood this morning and stick with earnings, reporting disappointing revenue as weaker crypto volumes drag down transactions. Shonali Basak has this story. Hey, Shonali.
Good morning, John. You are looking at crypto volumes really dragging down revenue over at Robinhood, but that's not just it. You also have options revenue lower than it was the prior quarter as well as a year ago, and equities also lower from a year ago. So transaction-based revenues really peaking here, just frankly, as the Dumb Money movie comes out. You have a lot of irony in the numbers here. You are watching the shares react to this, but Robinhood also reacting. Another thing I thought you would like is Robinhood here really diving into competition with the banks, with Vlad Tenev saying that they put a lot more value in products like Robinhood Gold, including a 4.9% annual yield on cash and a 3% match on IRA contribution. So the new excitement for the meme stock traders here, John, is earning some interest on their cash.
Have you watched the movie?
I have watched the movie.
What did you think? I enjoyed the movie.
I thought that it is too close to home.
Too close to home? I think it needed a little bit more depth, but that's us, I guess. That's the sort of Wall Street bias that you want a little bit more depth on those things. Shonali, thank you. It's a great movie. Check it out. Bit of fun. Let's stick on entertainment. Warner Brothers reporting a wider than expected loss due to an ongoing strike and weaker ad revenue. The CEO saying this: we will focus on driving future growth and creating long-term value for our shareholders. Geetha Raghunathan of Bloomberg Intelligence joins us now for more. Geetha, what stood out for you this morning?
They actually had a really good third quarter, John. I mean, whether it came to streaming profitability, when it came to free cash flow. But I think what really concerned investors was kind of this gloom and doom outlook for 2024. So the TV ad market is cratering. It is down double digits, down 12% in 3Q, and there's just no signs on the horizon of a recovery, of a reversal going into 2024. And that's kind of weighing on their EBITDA outlook. That is going to weigh on, some of their leverage targets. So overall, it looks really, really challenging for 2024, and that's weighing on all of the media sector right now.
How does this tee up Disney after the bow a little bit later, Geetha?
Yeah, so I think the streaming, one of the things that we look for always with the media companies is the streaming profitability number. And of course, there is no streaming profitability just yet. But even if Disney can report narrower losses, I mean, that's a big win. So of course, any commentary there, and then just kind of in light of the Warner Brother numbers and the comments on the challenges in the ad market, anything that Bob Iger has to offer in terms of how ESPN is holding up, how the rest of the assets are holding up, the TV networks, of course, that could kind of help assuage some of the fears, because right now, of course, everybody's very, very nervous about the health of the media landscape.
You and I have talked about this a few times already. What's for sale, what's not for sale, Geetha, over at the Walt Disney Company at the moment? ESPN, ABC, what's next?
So the linear networks definitely, I think, are very much fair game. Bob Iger has spoken about ABC, has spoken about some of the other linear networks like FX. ESPN, I think, is a little bit of a different story. They actually released standalone financials for the very first time for ESPN, suggesting that, they are confident in the health of that business. I think, though, they're definitely looking for some kind of cash infusion with maybe, a minority stake, maybe from one of the leagues, maybe from a tech giant. But I still think that they very much want to hold on to ESPN. I think it makes a lot of sense for them with that streaming bundle. They do have Disney Plus. They're looking to consolidate. Hulu get the 33% stake from Comcast. And so then to have ESPN Plus, a full-on bundle, I think definitely positions them very well in the streaming wars.
Geetha, we will catch up tomorrow following those numbers from the Walt Disney Company after the close a little bit later. If you're just joining us right now, 7 minutes into the session, equities advance on the S&P 500 for an 8th day. 8 days of gains on the S&P, 9 on the Nasdaq 100 right now, positive by 0.1%. TPW's Jay Pawlowski weighing in on the 2024 outlook, writing this: while concerns remain about lurking rate-related risks, we see a global economy that has handled many notable ones already. Jay, I'm pleased to say, joined us right now. Jay, it's good to touch base with you, as always, and catch up. Let's talk about next year. I find it so difficult now to get beyond next month, never mind the next 12. But Jay, what are the reasons you've got to be more constructive looking ahead and looking out 12 months?
Well, John, we tried to do something a little bit different this year in our 2024 outlook, and so we focused on macro surprises, and we identified 4 of them, and I'll highlight 2 here. The first is we expect lower inflation sooner than expected, both in the U.S. and in Europe. And we'll give you a couple of reasons why. In the U.S., you have falling rents down year over year. You have gasoline prices falling sharply. You have used car prices down sharply. So the inflation picture, we think, is going to be better than expected, sooner than expected. That gives central banks room to cut rates, and that should support risk assets, which, when coupled with our second macro surprise, which we think, and plays right to your comment, a return to stability, right? People talk about all the problems, and I identified some in our outlook. And even today, reading this morning, one headline grabbed my attention. Fear is everywhere was the headline, right? We think we're entering a stable period in the global macro space. And I'll give you 4 examples. 2 economy related. One is retail inventories in the U.S., right back to normal, right bang in line. The second, supply chain pressures, which have been a huge issue since COVID, right bang in line. And then on the market side, believe it or not, the VIX has averaged 17 year to date, again, right in the 20-year average. And the S&P, John, the S&P year to date is within 1 percentage point of its historical average for the 3rd year in a presidential term. So we think this combination, lower inflation, faster than expected, return to stability, is going to unlock what we've called the $1 trillion reward. And that $1 trillion reward is the money that's gone into money market funds this year. Now I think it's up to about 1.5 trillion just this year alone that's gone into money market funds. Some of that money is going to come back and go into risk assets.
It sounds like a game show. Let me pick up on the first point. Inflation is going to drop more quickly and sooner than people expect. Can you give me a little bit more color, Jay, as to why that's going to happen? Is that an improvement on the supply side or deterioration on the demand side?
Yeah, it's more the former than the latter, John. And one of the things that we highlight is that both the Fed and the ECB do not expect to return to target until late 2025. And we think we're going to be closer to 2% headline inflation in the U.S. and in Europe by the end of 2024. So there's actually, the central banks have built in a lot of cushion in terms of what their projections are. So they'll be able to say next year, if need be, that, hey, we're ahead of schedule and we can now take a rate hike or 2 off the table, which is now being projected by the marketplace. And as we pointed out, John, supply chain is no longer an issue, right? Gasoline prices at the pump have come down dramatically. Used cars, that was a big issue in inflation the last couple of years. And most importantly for the U.S. is that rents are coming down. That's a big chunk of the CPI, and we know for a fact that they're down over 1% over the past year, and that's going to feed into the inflation numbers with a lag, and that should be hitting here in the next 6 months.
I want to keep coming back to these 2 points you're making for your outlook, Jay. I think they're really important. One is ultimately you think inflation falls faster than people expect, and 2, you think we return to stability. There was a great piece in the Financial Times in the last week, an opinion piece from Brevin Howard, the chief economist over there, who talked about the new abnormal, entering an era of higher and more volatile inflation. Where is that stability, Jay, coming from? And what is it about where we are right now that makes you believe we can head back to the pre-pandemic conditions of several years ago?
Well, it's actually, we don't expect to go back to the pre-pandemic of low inflation and low growth. We think that 2010 to 2019 period was an aberration. Going forward, longer term, John, and you and I have touched on this in the past, we're believers that we're in the early stages of a global CapEx boom to deal with what we call the 3 C's of COVID, climate, and conflict, which is really reshaping the global supply chains into regional supply chains, which fits right into our tripolar world framework of regional integration in Asia, Europe, and the Americas. And we don't see this as an abnormal. We see this as the next step in the global evolution of how economies and markets are going to perform. So one of the ways we play this as an investor is we're looking for opportunities in some of the emerging market space where they are being integrated into these big 3 regions. So think about Mexico in the Americas. Think about Poland in Europe. Think about Indonesia in the Asia Pacific. So we see some really interesting opportunities. And by the way, the rest of the world not only offers growth potential, but is valued at a 20-year low relative to the U.S. and relative to their own history. The rest of the world is on a significant discount to where it has historically been. And that's where we really see the opportunities, in part because that lower inflation stability leads to a weaker dollar, and the weaker dollar, John, is really the global macro key as we see it.
Jay, I've been sitting next to Lisa all morning. The bullishness is just jarring. It's overwhelming. Jay Filosky at TVW. Jay, appreciate it. As always, mate, it's good to catch up. Very bullish, constructive. The bulls sort of standing taller after the move we've seen over the last week, that's for sure. 8 days of gains on the S&P 500, up by 0.2% on my screen right now. Coming up, crude flirting with multi-month lows despite the war in the Middle East.
Things can suddenly change very quickly, both in the Middle East, towards a negative, towards a positive. So that can really shift things.
That conversation up next.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
In a couple of drugstores, even in my area, which is not the poorest area in Washington, D.C., it's a nice upscale sort of area. When I want to get razor blades, you have to go to the front of the place and ask somebody to unlock it. Why are you locking up razor blades and other things that I might want to buy?
Yes. So, this is a national problem, and, this isn't, random theft. This is organized crime. And, state legislation has put guidelines on, how much the theft that you can steal before you're convicted. So it's a $1,000 limit. But we have been partnering with other retailers and sharing our camera feed. I know some of our partners here from Walmart are here, but we're all part of an organization that's coming together that says if you've, we can put our camera feed together and tell that that person has been in our store and their store and the numbers are higher than 1,000. So we've been able to impact these theft rings most recently.
What are the things that are unlocking key the most? What are people trying to steal the most, other than razor blades? I guess?
You know, I will tell you, it started at razor blades because that's such a high ticket item, but you know, it's a lot of cosmetics. But really what happens is that they take advantage of what I would call the elbow move, and they just come in and swipe a counter. And so it's just a matter of categories now.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
The market is preparing in case something were to happen. Things can suddenly change very quickly, both in the Middle East, you know, towards a negative, towards a positive. So that can really shift things. The market is waiting for evidence that actually we have tightness led by these supply cuts and demand isn't waning. Whereas, you know, on the other hand, if it continues waning, then we could see further falls in price.
Crude prices edging towards a 4-month low, even as the war continues in the Middle East. G7 foreign ministers ramping up the pressure on Israel for a pause in the fighting, writing this: "We stress the need for urgent action and support humanitarian pauses to facilitate urgently needed assistance." Israel's Prime Minister Benjamin Netanyahu remaining steadfast, saying this: "There will be no general ceasefire in Gaza without the release of our hostages." Your team coverage starts right now with Bloomberg's Anne-Marie in Washington, Will Kennedy in London. AMH, that pressure continues to build.
The pressure is palpable, Jonathan. This is on the heels of Axios reporting that on Monday, President Biden, in this phone call with Prime Minister Benjamin Netanyahu, talked about a 3-day pause to allow the facilitation of this dialogue to release those hostages and also to get humanitarian aid in. And then we see this morning on the sidelines of this G7 meeting that Secretary of State Antony Blinken is in Tokyo for, not just a statement from the G7, but he also came out and spoke about it alongside some of those others, foreign ministers from the G7, that there has to be a pause to allow this humanitarian aid in. But also notably from that interview with ABC News, Netanyahu, with the Israelis saying that they do not want to reoccupy Gaza, he is talking about an indefinite period where they need to have the security control of Gaza. So right now, Jonathan, there's a lot of pressure from Biden alongside other G7 countries to get some sort of pause to allow that humanitarian aid in and a dialogue for hostages.
And Will, then you look at crude and you're expecting higher prices and you've got lower prices. Will, just to go through the numbers together, you and I have been doing this now for a long, long time. To see what we've seen in the last month, we were in the 90s in October. Then we had a move lower of close to 11% on WTI. And now, Will, we're back in the 70s. Will, what's driving that?
Well, I think that a lot of people got long because of the war, and there was obviously that concern that it would spark a wider conflagration involving Iran. And I think that traders are now a bit more confident that won't happen, and they're looking again at the fundamentals of supply and demand. And while demand is broadly pretty robust, I think there's some concern about how the economy develops next year. There are some signs of weakness in industrial economies in particular, and supply remains pretty strong. We're getting more oil out of South America, Guyana and Brazil. Shale has probably performed a little bit better than people were expecting at the beginning of the year. And while Saudi Arabia is keeping its production down, there's been quite a little bit more oil out of Russia in recent weeks. And you put all that together, and suddenly the fundamentals, when you strip away the war risk, aren't as strong perhaps as they have been.
Just off session lows at the moment on my screen. AMH, Will, to the both of you from Washington and London respectively, thank you. Brent crude, $81 and about 30 cents. Brent crude's down about 0.4%. WTI, a break of 80. We're in the 90s, come all the way back down to 70s. 76.93. We're negative this morning by about 0.6% on my screen. The broader price action, about 21 minutes into the session, 8 days of gains on the S&P, make it day 9 on the NASDAQ, up 0.25% on the S&P 500. Let's get you some sector price action. Back with us is Casey.
You take a look at the sectors right now, you have 8 positive, 3 negative on a pretty quiet day for the overall benchmark. You take a look at what's leading gains right now. It's real estate up at the top, up about 0.7% or so. Big tech also having another good day. Industrials, materials also getting in on the action. That's the good news. You go down to the bottom of the screen, not too much to pick at here. Of course, communication services just slightly negative. Utilities, though, having pretty bad day so far, off by 1%. For once, energy is actually sitting on small gains, but as you were just discussing, it's been a rough couple of days, a couple of sessions, a couple of weeks really for the energy equities as you continue to see oil fall out of bed here. The energy index off by about 1.3% over the past 5 days. For the month of November, John, this is interesting. It is the only sector negative out of 11 in total.
Katie, thank you. For once also, I'd say this. Things are quiet in the bond market. Just in terms of the price action, 10-year yields not doing much, down a single basis point, 455. Had some comments this morning from some people in the market. The primary market, really, really hot on both the credit side, and you'll get some more Treasury issuance, of course, a little bit later. I'll give you a sneak peek of the numbers on what to expect from the Treasury for a 10-year and a 30-year through the next 24 hours. We'll do that next from New York City. Your trading diary coming up.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
I feel like a broken record. I've said it so many times already this morning, but here we go again. The longest daily winning streak going back 2 years, November 2021. It's day 8 on the S&P 500, day 9 on the NASDAQ 100. It's a lift once again this morning by 0.3% on the S&P. On the NASDAQ, up by around about a third. That's the price action in the equity market. Let's get to the trading diary. Next couple of days, look a little something like this. The US Treasury selling 40 billion of 10-year notes at 1 p.m. Eastern time. You'll hear from Williams, Barr and Jefferson. The Fed speak throughout the afternoon. Disney reporting earnings after the closing bell. Thursday, the Treasury sells $24 billion of 30-year bonds. The Fed speak continues with Bostic, Barkin and Chairman Powell as well. Look out for all of that in the next couple of days or so. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Kenyan athletes are getting better and better, and their times are getting quicker.
Agnes Tirop takes the win and the world record.
With all the success, there also is a dark side to it. And this comes about when men in the community look at women as prey.
The sports fraternity is in mourning tonight. A world beater, Agnes Tirop, was found dead today.
When you're moving into the career of athletics, you have to carefully look at who are the important people in your life. Even in a partnership, it can move into manipulation.
A lot of people let Agnes down. She felt that the threat was real. What she was told is exactly what happened to her.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Wednesday morning.
That's not the greatest way to start off the show with the microphone off.
Well, we got a little off kilter here starting off. Let's reset here. It's Wednesday morning. We got markets moving higher. That's a good thing. And we're going to talk to a lot of smart people over the next 3 hours. Talk about these markets with Carol Murphy. She's the CIO at Kestra Investment Management. Love getting her thoughts on the markets. We're going to hear from Michael McKee because I don't know what's going on in the economy. I don't think we're having a recession. Yet I still hear people talking about a recession.
Connor Sen thinks we are.
I know.
Look at Bloomberg Opinion today.
It is still all over the place. So we're going to talk to a lot of smart people, including John Tucker, who's going to start us off with a Bloomberg Business Flash.
Okay, the S&P 500 on track to extend its winning streak. Stocks posting some early gains right now. And again, it's technology in the lead. Apple, Microsoft, NVIDIA, all among the leaders. Fed Chair Jerome Powell making comments at a conference this morning, but no mention of Fed policy. Meantime, Sebastian Page at T. Rowe Price, he's been busy buying stocks.
I was reluctantly bearish for parts of the year. October 27th, market was down 10%. Sentiment and positioning, according to our indicators, was down 1 standard deviation. We decided to buy stocks.
And we have oil prices. They are down this session. And then the average 30-year mortgage rate plunging last week by the most in more than a year. The rate on the 30, that slid 25 basis points. Right now, hovering around 761. eBay, among the most active this morning, reporting after the close. They are, among other things, losing customers. Those shares down 5.5%. Overall, S&P 500, well, right now, up 3 points, pairing some of the earlier gains. 43.82 on the index. The Dow's up 59. NASDAQ 100 That has just turned lower, down 1 point. Doing the news this morning, I think the only story that anybody really cared about in terms of just judging from the feedback I got.
Legal weed in Ohio.
Fans of the beloved giant pandas at the National Zoo saying final goodbyes. The animals preparing to head back to China as early as today.
Oh. No, they're leased.
They're leased.
Yep.
I didn't know that.
This is Mei Jing and Tian Tian arrived at the
How did they know
National Zoo
how many pandas we have here? Didn't
in
the pandas have
2000.
like other pandas?
No, dude, there's a whole thing. So like, they're only given to U.S. zoos on a multi-year lease, and then even when they procreate, those are still the possession of China.
I didn't know
even though I would think as naturalized citizens, right, born in the USA.
Yeah.
No, that is an issue for immigration officials, I would suspect. They're headed back on FedEx aircraft, the FedEx aircraft called the Panda Express with 300 pounds of bamboo in the cargo hold.
Nice. All right, they'll go back in style. Very good. John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming on the YouTube thing. So head over to youtube.com and search for Bloomberg Radio. And Bloomberg
most importantly,
now Bloomberg is in your dashboard with Apple CarPlay and Android Auto. It gives you access to every Bloomberg podcast, live audio feeds from Bloomberg Radio, print stories from Bloomberg News in audio form, and the latest headlines at the click of a button with Bloomberg News Now. How do you get it? Well, it's free, which is good for John Tucker. It's free with the latest version of the Bloomberg Business app. So you got to go to the App Store, get the Bloomberg Business app. That's the Bloomberg Business app. Get it on your phone in the Apple App Store or Google Play. Just download the app, connect your phone to your car, and get started. And it's all presented by our sponsor, Interactive Brokers.
I was actually wondering myself if it was going to be free because even though I work here, and my mom and many other people in my family have a subscription to the Bloomberg.com thing. I don't. So I put the app on my phone. It's the white app, Bloomberg Business app, and then I plugged it into my car. And I clicked on there, and there's all this cool stuff. Like I have a few criticisms.
Okay.
Right. The Bloomberg News Now is such a cool idea, but it's way too short. Nathan Hager does it. It's only 4.5 minutes. I want to hear like all the news, you know?
But dude, I have to, at some point, I'm going to have to do that. It's just more work for me. So don't go saying it's too short.
I will help you.
Say it's too long, that it needs to be cut down.
I think it should
by the
be
way,
like,
you don't have to plug in anything. It's wireless. Boom.
Well, for you, it's wireless in your BMW X3.
BMW X3.
It's not wireless in my Challenger, bro.
Well,
I got to plug it in. Still with the old USB.
I'm glad but your Challenger, it's got an AM radio, though.
Yes.
Yeah, there you go. Boom. There you go. All right, let's check out these markets. Kind of mixed out there. Bailey Lipschultz joins us here. He covers all the markets for Bloomberg News. Bailey, what are you looking at?
Yeah, as JT mentioned, if the S&P can hold on to gains, it would mark an 8-day winning streak, longest streak since November 2021. But as you mentioned, a lot going on under the surface among the top performers in the S&P 500 this morning. Take-Two Interactive, ticker TTWO, right now up 7.1% after announcing plans to start promoting the next Grand Theft Auto, GTA 6. A lot of excitement on social media.
Okay, I am not a gamer. No surprise. Matt, you are a gamer.
I am.
Okay.
And I basically bought my car because it mimics, to me, the drive experience that you get in GTA 5. So,
all right.
Wow.
I like it. I like it.
Did you tell your wife? Did you give that to your explanation to your wife?
No.
Yeah,
not at all.
Another outperformer in the video gaming space, video game platform Roblox, ticker RBLX, right now up 19%, biggest jump on an intraday basis since February, this coming after bookings and revenue beat across the board. Really strong results for the video game platform. Popular among teenagers. Matt, I don't know if you're a Roblox guy.
No.
Wow.
It's like, to me, that's one of those things like Snapchat where I don't really understand what it is.
Okay.
But I get that the kids use it.
I just know a lot of people spend a lot of money on the gift cards. Anytime I'm at a department store, I always see parent age people buying a number of Roblox gift cards.
Really?
Yeah.
Incentivizing the use of games. Great.
Another company that kind of profited off of gaming, if it were, Robinhood, down 13%, ticker HOOD. Biggest slump in a year, results disappointing, missing on crypto volumes, which fell. When you really look at some of the reaction from the sell side, a lot of warning about pain ahead for a company that really has done nothing but struggle since going public. Right now it trades at $8.50 a share, and when it went public back in the day, it priced, I believe, at 30 something, and initially popped above 70. So a lot of pain for people who bought Robinhood high, company that again is down 13% this morning. Another underperformer, eBay, down 5.5%. Ticker is eBay. Muted holiday sales outlook. Really just kind of talking down expectations for 4Q.
Like, I don't know if that's an eBay thing or a retail sales thing. It kind of feels like it's an eBay thing.
Yeah.
I know holiday shopping is supposed to be tepid. I think the retail folks are calling it like low singles kind of growth or something like that, but I'm not sure if it's something specific to eBay a little bit.
Yeah, I mean, in our Bloomberg News story suggesting that they're struggling and losing shoppers to Amazon, to Walmart. So seeing that play out. Again, worst two performers in the SBU, though. Warner Brothers, ticker WBD, and Paramount Global, ticker PARA, that coming after a wider than expected loss for Warner Brothers.
Because of attrition, if nothing else, David Zaslav is now effectively kind of the spokesperson for global media. He's the media mogul. I mean, Bob Iger's back, but he's back temporarily. But, Rupert Murdoch no longer playing, Sumner Redstone's no longer there, and so on and so forth. So it kind of falls to David Zaslav to kind of be the media mogul. He basically just said on the conference call today, I don't know what the hell's going on out there. There's so much change going on in our industry. I can't give you like a clear path to when we're going to get it all figured out. And he's speaking as the industry, not just his company. So people are like, all right, geez, if he doesn't know.
But you, Paul Sweeney, could you pitch a deal?
Oh, sure. I can pitch a lot of deals. We got to get stuff done, guys. I'd be all over Disney here because I got a lot of assets. But anywho, that's just kind of how I used to roll. Anyway, anything else?
Notable underperformer, ticker KVYO, Klaviyo, recent IPO. Yes. Results were meh. I wrote a story yesterday basically saying when you look at recent IPOs, you have to come out swinging and crush your first two results. Yes. Did not really beat that strong and showed conservative guidance.
Inside pool here, we had the first 2 quarters baked.
Yeah.
When I took a company public, baked. The first 2 quarters, I could tell you to the penny what they were going to report back in the day. I don't think they do that anymore.
And they're back. They're back below IPO price, and we do have earnings from Arm and Instacart this evening. So 2 of the other 4 biggest IPOs that people are watching. If you can't beat expectations and you don't see strong follow through, it does seem like the uncertainty around the IPO and new issuance.
That worked. I tell you, that strategy worked for me for years until we had one company came out with numbers that we had no idea. So I got on the phone with the other underwriters, analysts, and we're all just sitting on a conference call saying, did you have that number? Where did that number come from? I didn't have that number. And nobody. So we'll just downgrade the stock. I just can't deal with this management team if they're not going to play ball. All right, very good. Bailey Lipschultz, we appreciate that. Bailey Lipschultz covers all the markets for us. Michael McKay joins us here in our Bloomberg Interactive Broker Studio. We're not really sure why, other than I think I've got every Fed president speaking somewhere today. What's going on with your Fed people?
I was reading Thanksgiving recipes. What do you guys think of cranberry barbecue sauce?
Not okay. Yeah. No.
Okay, so we're going to dump this.
Okay,
this article.
Okay, but where do you have that? Are you like a New York Times cooking subscriber?
Well, I am, but this happens to be a Washington Post story that says, "Let's turn Thanksgiving on its head."
Yeah. No, let's leave Thanksgiving exactly the way it's been. Thank you very much. I mean, if there's one holiday that we can be conservative about, I think it's Thanksgiving.
Agreed. Well, we should ask what Wall Street thinks of that.
Right, exactly.
Because that's why I'm here, because we're talking about what Wall Street thinks of all this Fed speak, which is basically nothing because they're not saying anything yet. Jay Powell was giving introductory remarks this morning, and our market stories coming into the morning were that the traders were awaiting Powell's speech for fresh cues, and he basically came out and said, welcome to the 100th anniversary of the Research and Statistics Division of the Federal Reserve. Let me give you a little of that history. and that was basically it. Now, he is talking tomorrow afternoon with Gita Gopinath from the IMF and also with the governor of the Bank of Israel, and so that is kind of timely in terms of what they're talking about. And they're talking about monetary policy challenges in a global economy. So he may want to keep it global, but he might throw in some stuff about the U.S. economy. And there is Q&A, so that one pay attention to, but the rest of it is all just kind of.
I mean, if you're the
treading
Fed,
water.
can't you just take a victory lap by just saying, we're good? Just,
that,
I mean,
that would be
victory lap
testing fate. I
yeah,
think.
I would, touching the money, as Boomer would say, but I just kind of think, what we're doing, it's working.
Well,
so we're just going to stay the path.
You go back to Vermont Senator George Aiken during Vietnam and how to get out of it. He said, just declare victory and go home.
Yes, exactly.
Okay, soft landing, we're done. You guys handle it.
Exactly.
No, the Fed is divided, not like terribly divided, but they're unsure about what's going to happen next. And the two camps are not far apart, but in the sense that they both think they've done enough, but some are more wary about needing to do more in the future. You heard Neil Kashkari on Bloomberg Radio yesterday saying that he's not sure. In the past, he was saying we should be raising rates, and now he's not sure.
It's interesting that nobody thinks they've done too much that we hear from.
Because you do hear people on Wall Street saying that.
On Wall Street, yes.
So much, but not from the Fed.
In
no.
academia, yes.
Yeah.
But not on the Fed. Nobody on the Fed says, we've had this thing licked, we raised rates a couple times too many, and we really need to turn around now.
Yeah, I don't think they would agree with that view. They look at real rates and think we're basically just getting to restrictive now. And the lags are long because people don't buy cars and houses, and companies don't invest in big projects every day.
I bought a house, I bought a car.
Except for Paul.
In this studio. What do you do? Real yields on the terminal? Is it USGG 10T?
No, I just go real.
Well, it depends on how you want to measure it. There's a million ways to measure.
Oh, but Tom Keen's, I'm looking at Tom. I think USGGT 10Y gives us Tom Keen's quoted real yield.
That would be the TIPS yield.
Exactly.
You could also use the ILBE function.
Oh, I love that one.
Great for the people driving
around. See inflation break-evens around the world. Set the yellow box to the United States, and then you get break-evens for every tenor in the United States.
What?
Or you could
too much math.
There's a lot of other stuff, other ways to look at it.
You really yields
and,
are positive.
And in a way, there's a bit of a debate at the Fed about that, because some people like to use the TIPS yield, which basically is what current inflation is, and then others say you should use forwards because it's what inflation's going to be that you care about, and so that's also some.
Or you do what I do,
tomato,
which is the daily national average gasoline price, unleaded, $3.40 a gallon. That's my inflation.
This is where we turn to John Tucker and get a Wawa report.
Yes, 333 was the fill-up this morning at the Wawa in Hazlitt, Route 36.
Nice. There you go. That is the center of the energy markets right
in New Jersey.
What about growth, Michael? Connor Sen has a piece on the Bloomberg terminal today saying it's time to prepare for
a recession.
But we just had a 4.9% print. I heard Michael Darda from Roth MKM talk about a little-known piece of the jobs report, like a one-week number that calculates hours worked plus wages.
Yeah.
And he says it tracks very well real GDP.
It tracks okay, but it in the sense of a sort of direction, but not in terms of an absolute, doesn't give you an absolute number. And there are a lot of factors that don't go into that can affect GDP, which we've seen lately, like inventories and trade numbers. So it's something to look at. The Fed is not looking for a recession at this point. Nobody thinks we're going to get 4.9% again. They'd be happy in the twos, but they have a feeling that if you look at incomes and spending, it does suggest that Americans are still have the money to spend and are still spending at least at a reasonable rate. This is the holiday season. We'll see. October last year was relatively strong in terms of sales. People seem to move up their holiday spending, but we'll see about this October, and then you got to kind of wait and get an average over the next couple of months of what's happening. But if people are still spending money, we're not going to see recession, and the Fed won't be cutting rates because the economy is contracting.
I thought you were going to say a little-known codicil to the Delta Charter.
No.
I thought that's where you're going. Okay.
Oh, man. I think probably most of our listeners are too old. It's pretty sad, but I don't think anyone, under my age really watches Animal House.
No, I don't know. That's a shame. Michael McKee, thanks so much for joining us. Michael McKee, he does all the economic stuff for Bloomberg Television. He's like our Fed guy, too.
Yes. I actually heard even when he has nothing to do at work, he still comes in early to look at charts and read through research and re-listen to Fed speeches. We watch old movies.
Yes.
Michael McKee listens to old Fed speeches.
I am so much fun at a bar on Friday night, I got to tell you.
All right, Michael McKee, very good. All right, we're going to have more coming up. This is Bloomberg. Let's get some company news right now with Denise Pellegrini.
Yeah, we're watching Citigroup. It's been ordered to pay, guys, almost $26 million. This is in fines and compensation for illegally discriminating against credit card applicants the bank identified as Armenian American. Citigroup didn't admit to or deny the CFPB's findings. Citi shares down fractionally. Shares of Roblox up about 19%. It's a video game platform popular among teens, posting third quarter bookings and revenue that far exceeded Wall Street projections. More from Bloomberg's Charlie Pellet.
Denise, bookings jumped 20% from a year earlier to almost $840 million, surpassing the $822 million that analysts had estimated. And the company's popularity among young adults delivered Roblox $81.1 million in adjusted earnings before interest, taxes, depreciation, and amortization, also exceeding expectations. The earnings beat marks a comeback for a stock that plunged in August after disclosing surprising misses in users and active playing time. An acceleration in advertising revenue and growth in new areas, including music and shopping, are expected to further fuel Roblox's sales in the coming years. Meanwhile, the company is turning to artificial intelligence to create more content. Charlie Pellet, Bloomberg Radio.
All right, thank you, Charlie. And shares of Take-Two Interactive, they are revving higher this morning, better by 6%. Sources telling us Take-Two's interactive Rockstar Games plans to announce the next highly anticipated Grand Theft Auto game as early as this week. It is set in Miami, and we're watching that very closely. Those are some of the company stories we are following for you this hour. I'm Denise Pellegrini.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We are on track for an 8th day of stock gains. S&P 500 higher. I'm going to call it a little change at this point. It's up 1 point. 6 of the 11 major industry groups are in the green right now. Technology shares Leading the way, once again, the biggest drag that's coming from utilities and energy as oil, that falls another 1%. NYMEX crude just above $76 a barrel. And, of course, Disney out with earnings after the close of regular trading in New York today. The Disney shares right now 6 cents higher. Fed Chair Jerome Powell said nothing this morning about policy in a speech. Swaps traders, meantime, pricing in almost no chance of an interest rate increase when they meet again, the FOMC in December. Again, S&P 500 up about I'm going to call it unchanged, 43.78. Dow Jones Industrial Average 39 points higher. The NASDAQ 100 right now, that has turned lower. It is 25 points lower. That is down 0.2%. And let's look at the 2-year 1 basis point higher. That's at 493. The 10-year 456, pretty much unchanged there. The long bond down 2 basis points. That is at 470. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Matt and Paul.
All right, very good. John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker studio. We're also streaming live on that YouTube thing. I think that's the internet. So go over to youtube.com and search Bloomberg Radio. Sean Scanlon joins us here, comptroller for the state of Connecticut. I live in Jersey. Matt's in New York, so we said, let's bring a guy in from Connecticut.
Tri-state.
Exactly.
Here we go.
Tri-state area. Sean, what does a comptroller do?
It's the question I get a lot.
Because it's not controller.
I just actually
Googled it.
Comptroller. So I'm essentially the chief financial officer of the state. We are the accountant. We pay all the bills, pay all the employees. I procure health care for 250,000 people. We do a lot of random things, but I guess CFO is probably the easiest way to explain it.
Okay. That being said, give us the state of finances in Connecticut.
Yeah, well, after a long time of people saying Connecticut's, best days are behind them, we've actually seen some big turnarounds, and our governor, Ned Lamont, deserves a lot of credit for that. He came in 2018. We passed a bipartisan budget the year before he got there that has basically set up some fiscal controls that are right now bearing a lot of fruit in the sense that we've had 5 years of consecutive budget surpluses. We've paid off almost $8 billion of our $40 billion of pension debt just in the last 4 years. And we've got a full rainy day fund for the first time in the history of the state. And a lot of that is due to us just staying with these fiscal controls that are obviously bearing fruit right now.
And before you were comptroller, starting in 2014, you were elected state representative for Connecticut's 98th district. So you're not new to this whole political thing.
Not new to the whole political thing, and I got elected really young. I'm the youngest person ever to get elected this job, so even though I look like I'm 15, I actually have been doing this for a little bit, and I'm in my first year of this job, which I like a lot.
All right, so I have a question that I've been asking for years and years. As I live in Westchester, I pay, like my property taxes are a German luxury sedan, right? Every year. And I get that we have very good schools in Westchester, and I get that we want our firemen to get paid, and the trash is taken out. But there are also very good schools in New Canaan or Darien, right? And the taxes are like a third of what they are in Westchester. Is that just because of graft and corruption that New York taxes are so high?
You didn't get the luxury sedan for your county tax payment, are you saying? No. Listen.
Why is it so high? New York and New Jersey are so much higher than Connecticut.
Layers of government, right? We don't have county government in Connecticut, so it's municipal government. Some people think that's a bad thing, and sometimes it is a bad thing, but when you pay taxes to your town, taxes to your county, taxes to your state, it just adds up and adds up. We don't necessarily have the services that maybe you do in Westchester County, but to your point, we've got amazing schools, we've got local police and fire, we've got great quality of life. And I think with this turnaround that we're seeing, we're actually starting to see people move. 57,000 people moved from New York State to Connecticut last year alone. You're starting to see that migration for obvious reasons, but also the reasons you're talking about.
So what's your take on the state and local tax deduction? Donald Trump and the Republicans capped it at $10,000 in 2017, ostensibly to raise revenue on the federal level, but it seems like it was more like retribution for those states that didn't vote for him. Is it helpful to you? Does it matter to you? Do you feel like your state is paying its fair share?
I think it's a problem. I mean, I think that I don't dabble a lot in federal politics because that would consume my entire life. But obviously, I think that it's having an impact on our region. You just joked about the tri-state. It's a tri-state issue. But for us, a lot of what we see is we have a lot of people that live in Fairfield County that work here in Manhattan every single day. And when that is adjusted properly, as we're doing now through these fiscal guardrails I'm talking about, when the markets are volatile, we actually save money, and it can't be spent by politicians, so that when things are not going well on the market, we don't have budget imbalance problems. And that is that fiscal guardrail that I'm talking about that's bearing a lot of fruit right now and helping us big time. But the SALT cap does certainly impact a lot of folks in our state.
So you mentioned that there are some people out there that feel like the best days for Connecticut may be behind it. I know maybe great financial crisis. I know a lot of people that I know just said, the hell with this whole Wall Street thing. I'm out, including, and they left the tri-state area. But that crystallized to me in terms of companies leaving Connecticut and going to other parts of the country. Where are you in terms of trying to attract corporate entities back into the state?
Yeah, for years, the model was, let's try to pay a company a lot of money to move headquarters to Connecticut. And I think now we're changing that a little bit to say, let's try to authentically grow companies in Connecticut. And we're seeing that a lot around biotech. Yale is a great resource for us, right? We're between Boston and New York. There's a lot of people who are starting to invest in that. And we're seeing tremendous growth right now with biotech and medical innovation. We obviously have Fairfield County. We do see companies, that have left in the last 10 years. GE left, for example, and that was sort of when everyone sort of said, "Oh my God, it's over." But you are seeing that growth coming back now, and I think that that's a testament to people just feeling bullish on Connecticut for the first time in a long time.
What are you doing for your employees? I'm about to go on 6 months of paternity leave.
Okay.
And when I tell people that, they are astounded that Bloomberg offers that. But of course, they also say then, hey, can I get a job at Bloomberg? Right? It attracts people, these kinds of policies, not just that. But I noticed that you've got some, reproduction policies. You've got some pharmacy benefits policies. So what are you most excited about?
Well, listen, I love the fact that we can sort of do things within that 250,000 universe that I oversee, which is all the state employees, their family members, the retirees. It's like a little bit of a petri dish where we can sort of experiment with what works. And we find that when you treat your employees fairly, you pay them well, you give them rich benefits that allow them to sort of feel like secure and valued in their job, they stay and they're productive. We learn that best from the private sector, right? Companies like this, where you treat your employees well, it's a good place to work, it's a good environment. If we can find out how to do that at a lower scale and with less money, we can get that job done. But it's Connecticut is a state that has paid family leave. So every single person in Connecticut pays 0.5% of their income every pay period towards a paid family leave fund. That allows anybody in the state to take advantage of that, to take time off for a baby, to take time off to care for a sick loved one. And so far that has worked. And I think companies have said, actually, this is good because we don't have to pay for it. You're paying for it, or they're paying for it.
What are the biggest challenges facing Connecticut these days?
Getting rid of that perception is still a problem, right? And we don't want that to be a self-fulfilling prophecy, so we want to change that perception, which is part of the reason why the governor spent so much time talking about, hey, it's a new day in Connecticut, to give us a look. But I think we continue to look at our tax structure. This year, we passed the largest single income tax cut in the history of the state, which is a big deal and affects literally 99% of our filers. The year before that, we passed the second biggest tax cut ever. So with these surpluses, with this better fiscal management, we're not just paying down our debt, which we have a lot of, but we're also cutting taxes and trying to figure out a way to make sure that Connecticut is going in the right direction and give guys like you some optimism that maybe you should stop paying those crazy taxes in New York and come over to Connecticut.
Absolutely love it. Absolutely love it. What about the transportation system? I mean, as you mentioned, a lot of women and men in Fairfield County work here, but also the whole Northeast Corridor.
Yeah.
I feel like right now is at a point where it could get better or it could get worse.
Yeah. Listen, the president just announced a couple of days ago he's investing a lot of money into infrastructure and specifically rail. That is going to help in Connecticut. There was 3 or 4 projects in that corridor itself that are going to get billions of dollars to help speed these trains up.
The House is looking at cutting Amtrak's budget by like 90% right now.
And this is the problem we have right now in politics, is that we don't have everybody on the same page about what our common sense things. If you live in this area, you should think that a train going faster and safely faster to Manhattan from Connecticut, Jersey, Long Island is a good thing for our
Boston,
national
DC,
economy.
yeah.
We have a thing in Connecticut called the 30-30-30. We want to get from Stamford to Manhattan in 30 minutes and from Stamford to New Haven in 30